morning, one and all. So welcome to the new day. So we'll be starting with the revision of IND AS 103 business combination. So business combination means what? It's a transaction where one company gets the control of another company. That's all. So if one company gets the control of another company, then we say it's the business combination transaction has happened. That's one. All right. So, but before you start IND AS 103 accounting, you need to quickly confirm, is it really a business acquisition or is it an asset acquisition? Is it really a business acquisition or asset acquisition? Because it makes the world of difference. So if it is business acquisition, then you will record goodwill, bargain purchase gain, net assets, NCI, DTA, DTL accounting. All this will come for business combination. However, if it is just an asset acquisition, all these things will not be coming. And in case of transaction cost, if you're incurring any transaction cost, in case of business combination, we'll transfer it off to P&L account. In case of asset acquisition, we shall capitalize that. That's the reason it's very important to find out whether have you really acquired some business or have you really acquired some other business, some assets only, not whole business. So how do we find that? Sir, now recently, this is not really an amendment. It came amendment almost 2 years back. Okay, they have just not modified that. So they've introduced something called optional concentration test. IND AS 103 has plugged in something called optional concentration test. So if this is optional, okay, if the company wants, they can take it, or if they don't want, they can choose not to take it. So if this particular test a particular company takes, and if this test ka result is pass, if this test is taken and if it is passed, means automatically it becomes asset acquisition, not business combination. Okay. So if it is asset acquisition, then you can't apply IND AS 103. You'll have to apply respective account ka standard. If you have acquired PP, you have to apply IND AS 16. Intangible asset, apply IND AS 38, like that. So if this test is taken and if it passes, directly it is asset acquisition. So how do you say this test is passed? We have to compute something called fair value of gross assets. If fair value of gross assets is equal to, or is it concentrated on any particular asset, if more than 90% of fair value of gross asset is it towards one particular asset, means we say this is an asset acquisition. Rather, this particular test is passed. Okay. All right. So how do you find out fair value of gross assets? For that, they've given a format. This is similar to your goodwill calculation. Take the fair value of consideration paid, fair value of existing investment, add non-controlling interest, add back the fair value of liabilities, because we want fair value of gross assets. So that's the reason liabilities you add back. Okay. If there is any cash or deferred tax asset, reduce that. Then the final number what you get is what we refer to as fair value of gross assets. Suppose you plugged in all these numbers in this format and got fair value of gross assets to be 1100. Okay. One example is there in study material. That's the data we have got. I've called in the same data over here. Suppose you plug in all these numbers and you got fair value of gross assets to be 1100. You checked, sir. One of the subsidiary assets is a building, and building ka fair value is 1000 rupees. That means what? Of the 1100 you have paid, of the 1100 which the parent company has paid, 1000 rupees is almost towards one asset called building. So what is the percentage? Almost 91%. So 91% of 1100 is concentrated on one asset. That means of the consideration, total consideration you have paid, 90% is towards one asset, means you have not really acquired a business. What you have really acquired is the asset. So that means this particular transaction we say has passed concentration test and it is an asset acquisition. Okay. So what percentage we should look for? There's only one example. They only use the word substantial, but they have not defined what is that substantial. And in our example, they have taken it as more than 90%. So in examination, probably you'll get the same question if at all they want to ask. Okay. Calculate this percentage. If the percentage is more than 90, then automatically assume it as that test has been passed and it's an asset acquisition and not a business combination. That way. Okay. So what if this test is not taken? If the test is not taken, because it is optional, right? If it is not taken, or if the test is taken and if it fails, then it becomes business combination, sir. No, then you have to do a further test. You need to check whether the company, excuse me, does that subsidiary company or where you have acquired the shares, does it have revenue already? If it is not generating revenue, like a startup company maybe, all right. So if it does not have generate revenue, then then what they say is you need to check whether the process is critical to generate the output. Obviously, every company will have a certain process. Like if you want to develop a calculator, automatically you'll not get calculator, right? There has to be a proper process, which machinery to use, okay? What raw material to put in, how long it should stay, after machinery number one, where it should go. Like this, there will be some protocols in process. So that process should be critical to generate the output. That should be one. And the second one, along with inputs, human resource also should be taken over. Human input means all your resources like your plant and machinery, intangible assets, inventory, etc., etc. All that we refer to as inputs. So along with the inputs, purchasing company should not only take over these inputs, but they should also take over subsidiary company ka human resource inputs. If both are satisfied, means then we say process is substantial, then it becomes business acquisition. Otherwise, no. However, the company is generating, the company who shares you have acquired, they are already generating the revenue, means same condition. The process should be critical to generate the output, and along with the other inputs, human resource also, or the skilled workforce also should be taken over. Or the process should be critical, and the process should be so unique or scarce that you can't replicate it without incurring significant cost. Like the technology companies, right? Your Facebook, your Google and all that stuff, right? If you acquire Google, it's not necessary Google ka human resource you need to acquire, because Google ka like technology is so advanced that you can't replicate it without incurring huge cost. That's the reason. So even if you have not taken human resource, it can be a business, provided the process should be critical and it should be very unique or scarce. If that is the case, means we say it's a substantial process and it becomes a business acquisition. Okay, this is one of the optional concentration tests that they have gotten. You may get some numerical or not numerical, theoretical case study out of this if they want to ask. Okay, that's one. All right, and excuse me, sir. So IND AS 103 is not applicable for few things. One is joint venture. Why it is not applicable for joint venture? Because in case of joint venture, there is no control. There is joint control. For you to apply IND AS 103, one company should have control over the other company, not joint control. It should have a total control. Since in joint venture, there is joint control. So for joint venture transaction, you don't apply IND AS 103. We have IND AS 111, apply that. For asset acquisition also, you can't apply IND AS 103 ka provisions. Okay. And business ka components. If you want to call it as a business, it should ideally have, we say, three components should be there. One is input, substantial process, and output. Input is your resources like plant and machinery, intangible assets, etc., etc. Process is the protocol which you have to use to develop the product, or to develop the final product, final output, whatever product that you're selling. Output is finally what you're going to sell, right? If your calculator dealer, means the final calculator, we call it as output. Okay, so for it to be a business, there has to be an input and there has to be a substantial process which is capable of generating the output. Okay, all right, so this is about these concentration tests and all. Next is, there are certain steps in business combination. It's not necessary you have to solve these problems in the steps only. It is just given. So if you want, we can quickly run through that. First is find out who is the acquirer. Which company has got the control? First find out that. Find out what is the acquisition date. On the acquisition date, the acquiree ka, meaning subsidiary company ka, all assets and liabilities has to be taken over at fair value. And you have to measure NCI also on the acquisition date. And NCI we already know. It could be either measured under fair value method or PSNA basis. If you measure NCI under fair value method, then the goodwill that you get is going to be the full goodwill, and both parent and NCI will bear the impairment loss. However, NCI is valued under PSNA basis, means the goodwill that you get is only partial goodwill or parent share of goodwill, and only parent will bear the impairment loss. Lastly, recognize the goodwill bargain purchase gain. This is the steps that we follow for IND AS 103. Okay, that's what is called out, but it's not necessary you have to follow the same steps. You can work it out in any order that you feel like. Okay, next is acquirer. Who is acquirer? Acquirer is one who has control over the other company, the parent basically, because the moment you get control, you don't call it as acquirer, we call it as parent, right? So for you to be an acquirer, you should have control over the other company. So how do you say you have control? You have to go back to the control definition, which we have already seen. You say you have control when you have power over investee, you have exposure to variable rate of return, ability to use the power to affect the return. Yes, and you have power over investee when you can direct the relevant activities, etc., etc. And as a thumb rule, we assume that if one company buys more than 50% equity shares or voting power in another company, by default, you will get the power. Okay. All right. Sir, PC paid in cash. Normally, acquirer is that person who will discharge PC. Acquirer is that person who will discharge PC. If PC is discharged in cash, then the person giving this cash or the entity giving this cash is usually the acquirer. However, if PC is issued in shares, if purchase consideration is discharged in shares, it's not necessary that the company issuing shares may be the acquirer. It could be other way around also, meaning we have learned something called reverse acquisition also, which we will spend it, a little later down the line. Okay. So when the PC is discharged in shares, the company giving PC automatically don't assume that they are acquirer. It could be other way around also, because in some cases, it could be a reverse acquisition, which we'll see. Next step is to find out acquisition date. Acquisition date means is a date on which the acquirer has got the control. The day you get the control, we call it as acquisition date. Next is step acquisition. Step acquisition means, name itself is saying step acquisition, meaning you are not getting control in one go, you are getting it in a step manner, in a stages. Like earlier, let's say A Limited had 10% shares, equity shares in B Limited. with the 10%, will they get control? No. Okay. Let's say a few months later, A Limited again purchased, let's say 70% shares in B. Earlier they had 10. So at this point of time, they didn't have control. When they purchased the additional 70% shares, obviously they will get control because now they have 80% in totality. Yes or no? So this scenario, we call it as step acquisition. So if there is step acquisition, what to do? So you would have purchased this 10% investment, let's say by paying 1 lakh rupees, no? So this is your date of control. Let's say this date is 1st July 2024. Okay. And you purchased this on 1st October 2024, few months later. Okay. So we always find out goodwill and all on the date of control. And the date of control here is not 1st July. It is 1st October 2024. On 1st October, what and all we need? Yes, how do you find out goodwill? We already have seen this, right? So first is you'll take the PC and you'll take net assets, you'll take NCI and compare it with net assets. But here PC is not given in one way because you already had 10%, no? So how do you calculate goodwill here is, first is the cash paid now for the 70% plus fair value of existing investment. Whatever investment you had already purchased before, we don't take the carrying amount of that. You have to find out the fair value of these investments on the date of control. The fair value could be 1,20,000 or whatever. Okay, so that means you purchased for 1, its fair value has become 1,20,000, means it has increased. No, it has increased by 20,000. That is a gain. You will transfer it off to P&L account. So whenever you get control, whatever previous investments you already have, it should be restated at fair value on the date of control. Okay, and if there is any difference between this amount and this fair value, that difference is nothing but your gain or loss, which will be transferred off to P&L account. This is the case of a step acquisition. Okay. Next, sir, first we will run through all the concepts over here and then we will probably take up the question, or we'll see at least. Okay, major part of the concepts, let's run it off first only. Okay, so for your checkpoint, no, whenever you're doing business acquisition problem, you can, for you as a checkpoint, you can remember there are 6 components which can come in your PC. This is more like your checkpoint. Okay, 6 components which will form part of your PC. One is cash. Okay, if you're paid, your PC could be discharged in the form of cash or shares. Fair value of existing investment, which we just now saw for step acquisition, and then deferred consideration, contingent consideration, prorated SBPR. These are the 6 components. If you want, you can remember them in the problem. As a checkpoint, you can check whether have you considered all of them. Okay, as a quick checkpoint: cash, shares, fair value of existing shares, existing investment, deferred consideration, contingent consideration, and prorated SBPR. All of them one by one, we will take it up. First is pretty much the cash. Cash means, or if you purchase the shares, you have discharged the PC by paying cash. Cash here means cash and cash equivalents, as in bank also. Okay. Shares means you got the control by doing an exchange transaction. You purchase subsidiary ka shares. In PC, you gave in a form of your own. Parent has given its own shares. That is one. Fair value of existing investment, we already have seen. Okay. Deferred consideration, which we will see, or maybe we can talk about it. Yeah. Here only we'll say deferred consideration means the parent is telling the subsidiary company ka shareholders, we'll give you PC. Let's say they are giving a PC, additional PC, other than the shares, existing investment, etc., etc. Parent is saying, we'll give you 10 lakh more, 10 lakh additional PC we'll give, but we will not give it now. We will give it at the end of year 2. We will give this at the end of year 2. You got the control now, okay? But this particular 10 lakh additionally parent is giving, but not now, but at the end of 2 years, meaning in future. So that sort of PC, we call it as a deferred consideration. Is that okay? All right. So that is one. And this also will form part of your PC. Okay. Sir, can we consider 10 lakh? No. 10 lakh is the future value. No? So you have to find out the present value of this. So the present value of deferred consideration will form part of your PC. In one problem, all this is there, it will come. Okay. Next is contingent consideration. Contingent consideration means you are giving another PC. Okay. But whether you will give this PC or not is dependent on another contingent event. Like parent company may say, I will give you another 30 lakh rupees as PC. Other than the normal PC, we will give you additional 30 lakh. Provided market price of the share increases after my acquisition by 30%. After the parent gets control, market price should increase by 30%. If that happens, let's say within 1 year, okay, like that, they have kept a time limit. After the parent has got control, within 1 year, if the share price is increased by 30%, then the parent will give 30 lakhs more. Or they could say EPS increases by 30%, sales increases by 40%, market share increases by 10%. Like this, they can put any contingency. Okay. So if those contingency gets fulfilled, then this particular thing will be given. Otherwise, it will not be given. So normally for these problems, even contingent consideration should be considered at fair value, and fair value of contingent consideration will be given to you in the problem. Straight away take it. Okay. Prorated SBPR, I'll take it up separately. I've written a separate chart for it. Okay. We'll talk about it there. SBPR, share based payment reserve basically. Okay. Then cost of acquisition. I already told you, sir. In case of business combination, if you are if you are incurring any cost of acquisition like due diligence, auditors fees, some legal consultants, investment bankers fees, some legal charges, etc., etc. All that we are calling it as cost of acquisition. In case of business combination, all this cost of acquisitions will be transferred off to P&L account. They'll be expensed off. Right. Next is contingent consideration, which we already discussed. They will give you the contingent consideration can also form part of PC. They will give you a fair value of contingent consideration. Consider that. So subsequently, what to do? Subsequently, check how this contingent consideration is valued. Okay, if you're giving contingent consideration in the form of equity shares, and that equity shares is classified as equity, means no remeasurement necessary, because equity does not have any remeasurement concept. Once you decide its value, that's all it is. Okay, so if contingent consideration is given in the form of equity shares, and if that equity share satisfies fixed to fixed test that we have studied, then you classify this as equity, no? So initially, only on the date of control, find out its fair value and record it at that fair value. Subsequently, whatever changes happens to that fair value is ignored because equity has no remeasurement concept. However, if you're giving contingent consideration, let's say in the form of cash, or you're giving in the form of variable number of equity shares. If you're issuing in variable number of equity shares, then you can't classify it as equity. You have to classify it as financial liability. So in that case, initially you measure it at fair value. Later on, any fair value changes, gain or loss, will be going off to P&L account. Any fair value changes subsequently will be transferred off to P&L account. That's the thing. Okay. Next is measurement principle. On the date of control, sir, all the assets and liabilities of the acquiree as in subsidiary company will be taken over at fair value. That's a basic measurement principle. On the same day, you have to measure NCI, and NCI cut to measurement principle, we already know fair value and NCI method, or PSN, proportionate share of net asset basis. That is one. Then there are some recognition and measurement exemptions or exceptions. All right. Normally, what is a simple rule? All the assets and liabilities of subsidiary company should be recorded by the parent at a fair value on the date of control. That is a normal rule. To this normal rule, there are some exemptions or exceptions. So let's see that. One is contingent liability. So what is this contingent liability? Sir, you already studied in CA Intermediate, AS 29 may also you have studied, IND AS 37 may also. We have not yet done. We will do it. Yeah. Excuse me. Excuse me. Yes. So contingent liability, no sir, is not recorded, but it is only disclosed. Contingent liability, if subsidiary company has any contingent liability, they will not record this, but only disclose it in notes to accounts. But if parent company has acquired subsidiary company, if they've got control of subsidiary company, and if subsidiary company has any contingent liability, even such contingent liability should be recorded at fair value. That's the recognition exemption. Because normally contingent liabilities are not recorded. But if this subsidiary company has any contingent liability on the date of control, then parent company will record that also. So hence that is a recognition exemption. Is that okay? That is one. Even if it is probable, they may use whatever word, probable, possible, whatever. Okay, but still you will record it. Okay, that is one. What is contingent liability? Suppose some case is going on. Somebody has filed a case against subsidiary company, and subsidiary company feels there is only 20% chance that we will lose the case. So that means it is obligation is possible. If the outflow is more than 50% chance, if the outflow has more than 50% chance, we say it is probable obligation and we make provision for it. If the outflow has less than 50% chance, then we call it as possible obligation. Possible obligation we don't account, but only disclose it as contingent liability. So that's what subsidiary has done. But parent should still record this. Another one is a related one is indemnification asset. Now somebody has filed a case against subsidiary company, means case is going on. Now parent has acquired subsidiary company. So do you think parent would like to take this obligation on their head? No. Parent may tell the subsidiary company, boss, it is your case going on. Okay. And if somebody wins the case, means money will go out of my pocket. So parent company may tell the subsidiary company, you indemnify me, meaning you compensate me. Okay. So if the subsidiary company has to pay some money to the person who has filed the case, now it's a loss for the parent, right? So parent may ask the subsidiary company to compensate. Such a compensation we call it as indemnification asset. So even indemnification assets are recorded. To what extent? Suppose you recorded contingent liability for 10 lakh rupees. The parent has asked the subsidiary company to indemnify for 15 lakh. Can you record it at 15 lakh? No. Contingent liability and indemnification assets go hand in hand. If contingent liability is recorded at 10 lakh, means maximum indemnification asset also you can record is 10 lakh, not beyond that. But subsidiary company, let's say, is given a guarantee of only 8 lakh. Then contingent liability recorded at 10 lakh, but indemnification or subsidiary is given guarantee only for 8 lakh. So in this case, you will only record it at 8 lakh. So basically, indemnification asset cannot exceed the contingent liability value, but it can be lower. So that's the thing. All right. Next is income tax. Income tax here refers to your deferred tax asset, deferred tax liability. So normally, sir, excuse me, Now let's take this particular example. One particular asset is shown by subsidiary company in their books at 1 lakh rupees. So one building or one land, the subsidiary company is showing in their books at 1 lakh rupees. But on business combination, we can't take over all the assets of subsidiary at book value. We have to take it over at fair value. Let's say fair value of this land is 1,50,000. That means now the parent will record in their books subsidiary asset not at 1 lakh but 1,50,000. That means the revised carrying amount will become what? The revised carrying amount. When this parent accounts this asset, they will record it at 1,50,000. Okay, because in days 103, that's the requirement. All the assets and liabilities have to be taken over at fair value. So we have recorded it. But tax base, if you just check, all this adjustment is done as per this particular 150 is recorded as per IND AS 103 provision. But as per the tax base, meaning as per tax record, the value will be 1 lakh only, because fair value concept is as per IND AS 103. Tax does not have all this. That means as per the tax, the value is still 1 lakh only. So the carrying amount and tax base is not matching. So there is a difference, and we already know this equation. I'll explain it to you later also when we do IND AS 12 later on. If for asset, if carrying amount is greater than tax base, then we create something called deferred tax liability. So here carrying amount is greater than tax liability by how much extent? 50,000. So on this 50,000, will we create deferred tax liability or no? We don't create DTL on the difference, but on the taxable difference. Let's say taxable tax rate is 30%. So multiply 30% to this, you'll get 15,000. So on this 15,000, you'll have to create something called deferred tax liability. So whenever you do a business combination, you may get some extra deferred tax asset, or for that matter, deferred tax liability. That's another recognition exemption. Okay, if subsidiary company has not recorded this, still when you do a business combination, you are required to account this. That's another one. Another one is the reacquired rights. Reacquired rights means, let's say the parent company has given some franchisee. Let's say parent company is McDonald's. What does McDonald's or Domino's and all do? One of the main businesses, they give franchisee, right? So let's say this parent has given their franchisee rights to one of the subsidiary company. So they've already given franchisee rights. So subsidiary is operating. Now the parent company acquired subsidiary company. Correct? That means what happened to that rights? All the subsidiary assets, again, parent has to record in their books. So obviously, if a franchisee rights is given by parent to subsidiary, means subsidiary is showing this as an intangible asset. Franchisee right is an intangible asset for subsidiary company. Correct? So whatever asset subsidiary is showing, parent will have to show that again. So that's what, hence the name. That means this particular franchisee rights again will come back to the parent books, because whatever is subsidiary is showing, again it will come back to parent books. That we refer to as reacquired rights. Okay, we had given the rights before parent, now they reacquired it. Okay, even reacquired rights should be recorded at fair value. All this data they will give it to you in the problem, so but record it, because the money that you would have paid as PC would also consider, would take into account this also, and accordingly PC would be determined. That's one of the reasons. Okay. Next is intangible asset. Intangible asset means one intangible asset, sir, we record as per IND AS 103, which is goodwill. Goodwill is not recorded as per IND AS 38 provision. I told you goodwill is recorded as per IND AS 103 provision. Okay, because you purchase the business, you are getting a goodwill. So hence this is a purchased goodwill and accounted as per IND AS 103. How to calculate this goodwill and all? Treatment is not given in IND AS 38. Treatment is given in IND AS 103. That's one. Another one is research phase expenditure. So we already did revised IND AS 38. Research phase expenditure. A subsidiary company is doing any research. What do you do for research phase expenditure? You transfer it off to P&L. But if parent company has acquired subsidiary company now, that means subsidiary company ka research also in a way parent has acquired. That acquired research also, though it is not, this research expenditure is not shown as an asset by subsidiary company, parent will recognize this as an intangible asset, because they paid money, no. Right, the PC that you pay will also include, or you would have paid PC by keeping the research expenditure also in mind. All right, so that's the reason, since the company has paid for it, it will be treated as a purchased research cost. So even this will be recorded. Hence, this is also another recognition exception, because as per IND AS 38, research expenditure you should not recognize it. Subsidiary has not recognized. What they've done is right. They have applied IND AS 38 and they have not recognized. But this is not IND AS 38 accounting. This is IND AS 103. So since the parent purchased a subsidiary company and subsidiary company was doing some research, indirectly parent has paid the money, or they paid PC towards this research also. So that's the reason even this research expenditure will be shown by parent and recorded as an asset. Hence the recognition exceptions that we're talking about it here. All right. Okay. Next is asset held for sale. So normally what is the thumb rule in business combination? All the assets and liability you record at fair value. But however, if any asset that you acquired, parent acquired one subsidiary assets due to business combination, but if that asset by chance is classified as held for sale, then such asset will not be measured at fair value. They'll be measured at fair value less cost to sale, meaning their measurement will be same as per IND AS 105 only. So normally you record the asset at fair value, business combination assets and liability. But this is the only asset where if you have acquired any asset and if it is classified as held for sale, you will not show it at fair value, but fair value less cost to sell. Hence, it's a measurement exception that we are talking about it here. And in case of leases, so if subsidiary company is showing if they've taken any lease, so subsidiary company would have showed ROU and lease liability, right? So this lease liability now has to be recorded by parent. This lease liability, the parent will record it at what value? Fair value. And how do you find out fair value of lease liability? We already know this. Present value of future lease rentals remaining. Yes. So the parent will henceforth record lease liability at present value of the remaining lease payment. Suppose another 2 years ka lease is pending. So that means 2 years ka future cash flows is still pending. Find out the future value or the present value of future cash flows. That is the lease rental. Whatever is that value parent will record this lease liability at. And ROU and lease liability will be recorded at the same value there. Lesser, if it is a lesser arrangement, means as per the agreement you do the accounting. Okay. Assumed workforce. What does this assumed workforce means? So subsidiary. So one of the biggest organization of any asset is the human resource, is the people, right? So the question is, can parent record subsidiary ka human resources? No. Human resources you don't have control. No, since there is no control, because see, if you have fixed assets, you have control over it. The way you want to use it and all, you have a right over it. But when it comes to human beings, you don't have control, because tomorrow if they want, they'll quit and join another company. So human beings are never recorded as an asset. So we assume, so we don't recognize if subsidiary has any human resource, no matter how good or bad they are, still human resource will not be recognized as an asset. It is assumed that human resource value is included in the value of goodwill, because you're paying extra means you'll show here as goodwill, right? So that human resource ka value, we assume that it's already included in goodwill ka value, like that. That's the assumption. But do not show human resource separately as an asset. Okay. Then another one is bargain purchase gain. How do you get bargain purchase gain? First of all, how do you get goodwill? In fact, goodwill working note, if you want, just calculate how do you get goodwill over here. Excuse me. First, calculate the PC. Or maybe we'll take a small example. Purchase consideration. Let's say purchase consideration is 10 lakh. Let's assume it's a normal case. It's not a step acquisition at all. We purchase 70% stake by paying 10 lakh rupees. So take this. Add non-controlling interest. Let's say non-controlling interest is 3 lakh rupees assumption. Then deduct what? Fair value of net assets on the date of control. Okay. Let's say this is about 8 lakh rupees. Okay. So what are you getting? Deduct this. The balancing figure you're getting is what, sir? 5 lakh rupees, right? So that balancing figure only, we call it as here as goodwill. And this is the goodwill on the date of control. Yes. Okay. Suppose I modify the numbers. Let's say this is same 10 lakh, 3 lakh only. Fair value of net assets was not 8 lakh. Let's say it was 15 lakh. By chance, if it is 15 lakh, then are you getting positive number or negative number? You're getting negative number of 2 lakh. That we call it as bargain purchase gain or BPG. BPG. Okay. So basically what's it? Here purchasing company, it's a simple funda is this is 100%. The worth of that subsidiary company is 15 lakh. Okay. But parent has paid much lesser than the worth. Hence the purchasing company has made a profit. That profit only we here refer it to as bargain purchase gain. In your AS 14 terminology, straight away you used to call this as capital reserve. Okay. In this scenario, the worth of that asset is only 8 lakh, but parent company has paid more. Since parent company has paid more, they have made a loss. That loss, IND AS 103 asks you to account it as goodwill. Okay. Because maybe the goodwill generated by subsidiary company over many years, they have to pay a lot. Parent has to pay some extra money. That's the reason. Okay. So basically loss scenario, we call it as goodwill. Gain scenario, we call it as bargain purchase gain. So what about bargain purchase gain, sir? So IND AS 103 says bargain purchase gain is a very rare scenario. Why? Because if you think logically, why? See, bargain purchase gain will only happen when somebody sells their business at a lesser price. When the seller of the business sells it at a lesser price, only then the purchaser will make profit. That profit only we're calling it as bargain purchase gain. Would any seller like to sell it at a lower value? They would like to sell it at their worth or maybe higher than the worth. Would anybody like to sell it at lower than the worth? Most probably no. That's the reason IND AS 103 says bargain purchase gain is a very rare scenario. Whenever you get bargain purchase gain, recheck. Have you calculated all the fair value of assets and liabilities properly? Is all your calculations proper? You feel yes, all the calculations are proper. Then what IND AS 103 says is, do you know the reasons why you got bargain purchase gain? Why you landed up in profit scenario or bargain purchase gain scenario? Do you know? If you know the reasons, then show this bargain purchase gain in OCI. Now SPL has 2 components. Statement of profit or loss, when you prepare it, has 2 components. One is the main SPL components, and next we will show OCI components. So if you know the reasons, then this bargain purchase gain will come in OCI, and also it will come in your balance sheet other equity as capital reserve. Okay, it will come in both. SPL section of SPL section under OCA, and as well as it will come in your balance sheet other equity. If you know the reason why you got it, if you don't know the reason, then it will not come in SPL. You will only directly show it in other equity as capital reserve. You can't show it in the SPL section. Okay. So what could be the reasons? One of the reasons could be your stress sale. Let's say a subsidiary company is under losses. All right. They want to get away. Like they have to pay a lot of money to a lot of people. Okay. A lot of people are asking questions. So they want to sell away the business as soon as possible. So if they're already under a stress, so that means they may not sell it at their worth. They may sell it at a little lower than worth also and kind of be done away with this transaction. So could be a stress sale, could be one of the reasons. Okay. But any which way, standard does not say you have to know the reason. If you know the reason, show it under SPL and then other equity as capital reserve. Otherwise, just show it under other equity as capital reserve. No need to show it in SPL. That's a thing about bargain purchase gain. Next is measurement period, which is MP. Okay. So what is this measurement period concept? Excuse me. What it says is, one second. Now, sir, to do business combination, you need fair value of net assets. You can't take book value of net assets of subsidiary company. You need a fair value of net assets. Sir, fair value finding out is not an easy job. And moreover, subsidiary company will not have one or two assets. They may have hundreds of assets. To find hundreds of assets of fair value is not an easy task because not everything is easily sellable. Some they'll have some unique assets and all, like internally generated patent, software, giftware and all. So it may not be that easy to find out fair value, especially within the stipulated time. Once you do business combination, that is also time-bound activity, right? Both the companies would like to finish this transaction as soon as possible. They don't want to drag it, right? Yes, because there will be too much of cost, etc., involved. So hence, IND AS 103 recognizes that. I know that everybody, I mean, the companies will be in a rush to complete the business combination. So you may not have enough time to find fair value of all the net assets properly. So hence, IND AS 103 gives you an extra leeway. This is take 1 year time. From the date of control, take 1 year time and see if all the fair value of net assets have you computed properly or not. If you feel some assets ka fair value is not determined properly, then you can revise those net assets. Okay, some extra time is given for you to revive those or to recheck your net assets. If you feel you have done some mistakes or you did not consider all the data, etc., you can revise your net assets. So if you revise net assets, obviously this number will change. If this number changes, goodwill you're getting as balancing figure, so goodwill also will get changed. Okay, but they brought in few conditions. So if you want to change your net assets and accordingly change your goodwill, there should be two conditions that should be satisfied. One, it should be within measurement period. Measurement period is 1 year from the date of control. Okay, you can only do it within the measurement period. After measurement period, you cannot do anything. So one is that. And second, the facts should be existing on the date of control. New facts and all don't consider. Okay, I mean, the condition should be existing. Further evidence, if you get it later, it is fine. But the facts should be existing on the date of control. Like, let's say, subsidiary, let's say P Limited acquired, let's say 90% shares in S Limited. And somebody had filed a case against S Limited. So S Limited is showing contingent liability, let's say 10 lakh in their notes to accounts. Okay. Now parent company cannot show this contingent liability notes to accounts. They have to record in their books. So parent company determined that the fair value of contingent liability of this is, let's say, 12 lakh rupees. So the parent, when they did business combination, they would have recorded this contingent liability at 12 lakh based on the facts existing on that particular day. Later you got to know that, okay, later you got to know some extra information that actually the value of contingent liability is not 12 lakh, it is 18 lakh. It is 18 lakh. That means what? Now this 12 lakh, they will revise it and make it as 18 lakh. So if contingent liability changes, how do you get net assets? Basically net asset is asset minus liability. So if any of the asset changes or any of the liability changes, net asset also will change and accordingly goodwill also will change. So since the fact was existing on the balance sheet date or on the date of control rather, not balance sheet date, yeah. Since this particular fact, this condition was already known to us on the date of control, all right. Further evidence we have got it later. So condition was existing. So that means you can now take away 12. Instead of 12, you can consider 18 lakh and accordingly revise your goodwill or bargain purchase gain like this. Okay. So two conditions. One, it should be exist. This should happen. This change should happen within measurement period. If you're doing the change beyond 1 year, not acceptable. If you want to do the change, it has to be within 1 year from the date of control. That is one. And two, the facts should be existing on the date of control. New things, if you new facts and all, if the facts was not existing, sorry, you cannot change it. Additional evidence, you can get it later on, that's fine. But the condition or the idea about all this transaction should be there. Okay, fair enough, like this. Suppose if I modify this example, So somebody filed after the date of control, some new cases, somebody filed a new case. This is the existing case going on. Some new case was filed against subsidiary company after the date of control. Okay, not the same customer. Some random third party filed a new case against subsidiary company demanding a compensation of 5 lakh. Now this 5 lakh should parent record of? No. Why? So the facts, though it could be under measurement period, let's say after 3 months after the date of control, this particular new case was filed. So it is it within measurement period? Yes. Measurement period is 1 year from the date of control. So is it within measurement period? Yes. But was this fact existing on the date of control? Was this condition existing on the date of control? No, this is entirely new. So if it's a new data, you can't account it. So fact should be existing. Further evidence, you can get it later, but the facts of the condition should be there or it should be available on the date of control. Only then you can revise. So that is one. Okay. All right. And also do keep in mind, there's one more hidden implication over here. Sir, if net asset changes, obviously goodwill also will change. But another thing is, if net asset changes, not only goodwill, your NCI also may change. Sir, how, sir? Sir, NCI also you can measure under PSNA basis, no? Proportionate share of net assets. So by chance, if you are measuring NCI under PSNA basis, now due to this measurement period concept, if you are applying a measurement period concept and changing net assets and revising net assets, then don't automatically change goodwill. First, you have to change NCI and the balancing figure only you'll have to bring it under goodwill then. Is it okay? That's what I've just called out over here. If NCI is valid under a PSNA basis, then measurement, due to measurement period, any of the component of net asset changes means NCI balance also will change. And the balance changes only you have to record it in goodwill or bargain purchase gain. Keep that in mind. Okay. All right. That's what I've called out over here. Next is contingent payment to employee shareholders. Let's say their subsidiary company has some employee shareholders, meaning their employees also, and they own shares in subsidiary company also. Okay. Now let's say parent is given normal PC. PC is given to everybody, right? Other than normal PC, let's say to these employee or employee shareholders, purchasing company, parent limited, let's say, is giving additional 30 lakh rupees. Other than the PC, okay? PC is given to everybody, okay? The parent told to these employee shareholders or employee of subsidiary company. These are employee subsidiary company, okay? Parent limited, parent is telling these employees of subsidiary company, will give you additional 30 lakh. Will give you additional 30 lakh. Now the question is, this 30 lakh should be treated as PC or should we treat this as an employee benefit expenditure? Employee benefit expenditure means it will be transferred off to P&L account. These are not routine expenditure which will be transferred off to P&L. If it forms part of PC, then it will be considered for your goodwill calculation, right? So this 30 lakh, I should consider it as PC or employment benefit expenditure was the question, all right? So what the standard says is check. Okay. Now let's say the parent is telling the subsidiary employees, I will give you 30 lakh provided you stay in my organization for 2 years. If you stay in the organization, parent is saying, I will give you 30 lakh rupees provided you stay in the organization for 2 years. So if this is the case, means it is an employee benefit expenditure, meaning the parent is giving this money to get some extra service from those employees. Okay. That means this is not towards business acquisition. This is more towards to get additional service from employees. So in that case, it will be an employment benefit expenditure. Okay. Now, if I modify the example, if I tell parent limited will give 30 lakh rupees to subsidiary employees. Okay. All right. And same condition is put forth by the parent. Stay in my company for 2 years and I will give you 30 lakh rupees. Same thing parent told. But parent added one more thing. Even if you quit within 2 years, still I will pay. Okay. The main condition is stay in my organization for 2 years. And add on what are they told? Another clause what they're telling. Even if employee quits within 2 years, still he will get it. That means what? It's really service based. Whether he works for 2 years, he doesn't work for 2 years. Employee works for 2 years or doesn't work for 2 years. Anyway, he will get this. So in that case, it will form part of PC. So you have to do a case-to-case assessment in these sort of cases, right? So if the payment is towards service, then book it as employment benefit expenses. If it is not towards service, then that particular component or that payment will form part of your PC calculation, like that. Okay. Next is SBPR. We saw initially, prorated SBPR, share-based payment reserve. That we are talking about it here. Excuse me, acquirer SBP awards exchanged for acquirees employees. So what is happening is, let's say P limited, let's say there's S limited. Sir, S limited now sir has some share based plan. They have some ESOP plans or some share based plan which they're giving to their employees. This is already running. Okay, let's say original period of this plan was, original vesting period was 4 years. Okay, 2 years has already elapsed, or let's say 3 years has already elapsed. Subsidiary company already has some share-based plan. They introduced this plan 4 years ago. Okay. I mean, original vesting period was 4 years. 3 years is already passed. I mean, how many years is remaining? 1 year. Now, parent got the control. P Limited got the control of, let's say they acquired, P Limited acquired 100% of S Limited. Whatever. We are not interested in percentage. We are interested in control. Control you get with more than 50%. So this percentage, as long as the P gets control, percentage doesn't matter there. Okay. So now what the parent limited or P Limited did is, so S Limited already has some share-based plan. What parent did is they cancelled this plan because this plan belongs to S Limited, no? So they cancelled this plan and they replaced it. P Limited replaced subsidiary ka share-based plan with parent ka share-based plan. Okay. P Limited is saying, let's cancel this plan. Okay, to S Limited ka employees, these plans were given to employees. P Limited is saying to these employees now, I will give the shares. P Limited will give its own shares to S Limited ka subsidiary ka employees. Okay, that is what we are studying over here. This we call it as exchanged. Acquirer, meaning P Limited over here, SBP awards exchanged with acquiree ka employees. So parent is giving its own shares to subsidiary ka employees like this. If this is the case, means what to do is the concept, because it could happen also. So why do they do this? It depends, sir. Because if a subsidiary company has share-based plan, means now the shares will be purchased by employees. Now parent may not want to dilute their control, because if the employees purchase S Limited ka shares now, P Limited ka shareholding will get diluted. It will reduce. Maybe P Limited doesn't want dilution of control to happen. That is the reason this shares they cancel and they have given parent ka share. So whatever the reasons could be, whatever. Let's not go into the reasons as such. Okay. But if this has happened, means what to do? Now, if you think about it, all right. Now P Limited is giving some payment to the employees, and we know this as a thumb rule. Like if you're giving the payment to the employees and getting some service, if the payment is towards service, you will book it as employment benefit expenditure. But if the payment is not towards service, means previously only saw, it should we should form part of PC. Now you think logically, sir, what was the original vesting period? 4 years. How many years has already happened? 3 years has already happened. That means 3 years has already happened, means employee has served whom? For 3 years, employee has served or given service to S Limited. That means ideally who has got the benefit here? If employee gives the service, means obviously S Limited, although if S Limited ka employees serves for S Limited, means S Limited will get benefited. So P is not getting benefited here because P just came now. Correct. They got the control only now. That means ideally for 3 years, P should not give any benefits to these employees. But still if they are giving, means then they're not getting any service for this 3 years because 3 years is already over. So that we say is prorated SBPR, and that prorated SBPR should form part of PC. Okay. Again, I'll tell you, in this 4 years, 3 years is already passed. So that means who got the service for those 3 years? S Limited. Is P Limited getting any service? No. For 3 years, they're not getting any service, but still they're giving SBP plans. That means whatever is the SBP plan related to these 3 years, those 3 years already lapsed now, that portion is P Limited is not getting any service. That means that should form part of PC. That only we are referring to as prorated SBPR. And how do you get prorated SBPR? Given as a small formula, fair value of the old scheme divided by original vesting period or revised vesting period into vesting period completed. It's what it's called over here. Let's say fair value. Obviously, share-based plan means it will have a fair value. Let's say fair value of the scheme is 4 lakh rupees. Assumption. So how do you calculate prorated SBPR? Prorated SBPR is fair value of the old scheme, which I was assumed to be 4 lakh, divided by original vesting period. What is the total original vesting period? 4 years. Or revised vesting period. Sometimes what happens is this vesting period, after acquisition, parent company will reduce it. Okay, they will give you in the problem if at all it has happened. Let's assume it has not happened over here. Okay, original vesting period or revised vesting period. Let's say that is not over there here. Whichever is higher you will take, because revised vesting period, no data is given, so I'm just simply writing it as 0. Multiplied by number of years already completed, by vesting period completed. How many years completed already? 3. That means you will multiply 4 lakh divided by 4 into 3, which is what, sir? 3 lakh. 3 lakh. So this 3 lakh is your prorated SPPR, which will form part of PC. Okay, like this. Fair enough. So what about the remaining? So normally, sir, who is giving the shares now? Who's giving the shares? S Limited or P Limited? P Limited. So that means you need what? Fair value. This 4 lakh is the fair value of the old scheme. Old scheme means it belongs to S Limited. So you need to find out now the fair value of the new scheme. New scheme means relating to the parent company. Let's say that is 7 lakh rupees. Assumption. Because obviously the fair value of the shares of S Limited and P Limited need not be same. So let's assume the fair value of New scheme of P Limited is 7 lakh. So in this 7 lakh, 3 lakh, sir, you deduct 3 lakh because 3 lakh is forming part of PC. Balance 4 lakh only, you will treat it as employment benefit expenditure, like that. Okay. So this is how you find out that. So again, this calculation also will come in one of the problems later on, which same thing, whatever I've done now, you'll get a little extra data. That's all it is. Okay. Fine. So this is about prorated SBPR wala draft. Okay. So what if they have not replaced? If they have not replaced means, suppose this particular scheme is not replaced by the parent. So scheme still running because subsidiary company is not shut down. Only P has acquired control of S Limited. Subsidiary company is still going on. So if they don't replace this plan means, then the employees will buy shares of S Limited. If employees buys the shares of S Limited means parent ka control will get reduced. These employees will be called by the parent as NCI. Okay. So if there is non-replacement award means, the find out the same prorated SBPR you find out, but add that prorated SBPR to NCI. Because again, if the scheme continue means the employees will buy additional shares of S Limited. If the employees buy additional shares means they all become other than the P, whoever has the shares in S, that only we call it as non-controlling interest. So if it is non-replacement award means again find out prorated SBPR, that will form part of your non-controlling interest now. That's all it is. Okay. All right. Disclosure is not really that important. In fact, I've given you the prorated SBPR ka. All this we did in regular class. So I think, yeah, it's fine now. I'll leave it. I'll leave that there. Okay. All right. So let's do a thing. Let's see if you have any questions. We can take up anything quickly. I think this particular question we can take it up. Question number 10. On 1st April 20X1, P Limited acquired 30% voting power of XYZ. With 30%, you don't get control, you only get significant influence. Okay, that means PQR has an associate company called XYZ. Associate means you will have to follow equity method of accounting. Yes, investment should be shown at using the equity method. And they've acquired it for 8,000. PQR accounts its investment using equity method as prescribed under IND AS 28. At 31st March 20X2, PQR recognized its share of net asset changes in XYZ using equity method. Okay, and we know this, right? In equity method, if associate company makes a profit, investment balance will increase. If associate makes any OCI profit, then parent will record that also by increasing investment. If associate reports loss, then investment balance will reduce. So they've given that data. Associate share of profit. This is not associate ka profit, share of profit. So investors share of associate profit only, they've given 700 crores. Exchange difference in OCI. Associate has an OCI. Okay. So if they just say OCI, always assume it as a gain. Okay. And don't assume it as a loss. Okay. Then share of revaluation reserve is 50. So again, we don't record so basically exchange difference OCI is basically a reclassifiable OCI. Revaluation reserve is a non-reclassifiable OCI. Okay. So that you need to keep in mind. So put together, how much is this? 850. So if all these are there means investment balance will increase. So from 8,000, it will increase by 850 and it will become 8850. I think that's what they've given. Carrying amount of the investment at the end of the year has become 8850 because 8,000 plus this number. Okay. On 1st April 20X2, next year, P acquired remaining 70%. Oh, earlier they had 30%. Now they got 70%. So it's a case of step acquisition. Okay. We know the provision of step acquisition. What is that? Whenever there's step acquisition, previous investment, currently you're showing the investment at what value? 8850. That you have to value it at fair value. Fair value on which date? On the day you get control. This particular investment, you have to bring it to fair value now, on the date of control. That value could be higher than 8850 or lower. Okay. If it is higher, you will book a gain. If it is lower, you will book a loss, like that. Okay. And moreover, now you have significant influence or you lost significant influence. You got control means you can't have both significant influence and control, right? The moment you get control, significant influence is lost. And you know the accounting. Whenever significant influence is lost, whatever OCI, it's a reclassifiable OCI, no? That will be transferred off to SPL account. And non-reclassifiable OCI will be transferred directly to retained earnings. So all this you have recognized, you need to de-recognize it now because you got control. That's the reason. And you lost significant influence, more specifically. Okay. So they acquired 70% for 25,000 crores. Great. Following additional information is available. Fair value of 30% investment is 9,000. Okay. Carrying amount is 8850. Fair value is 9,000. That means there is a gain of 150. 9,000 minus 8850, which is gain. That will be transferred off to SPL account. The fair value of identifiable assets of subsidiary company is 30,000. Great. How should you account this business combination? Sir, whenever you get control, what do you have to do? So far you were an associate. So you were showing investment. Now can you show investment anymore? No. In consolidated financial statement, investment cannot be shown anymore now. But you have to show subsidiary assets. you will show non-controlling interest. You'll have to show goodwill or bargain purchase gain. If at all there is a DTA, DTL accounting, that will come, etc., etc. Yes, so all that you need to do over here. So first, let's find out the goodwill. Okay, so in fact, gain also I've given here. Carrying amount of the investment under equity method is 8,000. Fair value is 9,000. So the gain will be 150. Not only this gain, we had some reclassifiable OCA. No? How much is our reclassifiable OCA? 100. That will also be transferred to P&L account. This gain on SI lost. This is a gain on significant influence lost, in fact. Yes. So that will also be transferred to P&L. 100 also will be transferred off to SPL. So total gain is how much? Total gain that you will transfer to SPL is 250. That is one. And OCI, non-reclassifiable OCI, will be transferred off to retained earnings. So now let's find out the goodwill, because you got control means you need to find out the goodwill. How do you get goodwill? Cash. No cash is there. But yeah, I don't know how we paid. I think we paid this in cash only. Where is that? Somewhere they told, no, we acquired the remaining 70% for 20. Oh yeah, in fact, cash only. So first is cash paid. Consideration paid 25,000. Then add fair value of existing investment. Do you have fair value of existing investment? Yes, which is 9,000. Then earlier we had 30%, now we bought 70%. That means, is there any NCI? No. If the NCI was there, means you would have added, but here the NCI portion is nil. That's the reason they've ignored that. Okay. Then what's deduct fair value of net assets, which is 30,000. Okay. So you're getting a positive number, meaning it's a case of a loss for the purchasing company, which we call it as goodwill. So goodwill we have accounted. Now one journal entry you need to pass in your consolidated financial statement. What is that? Recognizing the assets, NCI, goodwill, bargain purchase gain, etc., etc. First, you will recognize net assets of subsidiary company at 30,000. You will recognize goodwill at 4,000. Yes. Then currently you are showing already investment. Can you show investment anymore? No, you have to derecognize. What is the carrying amount of investment? 8850. Derecognize that. But to get this control, parent company paid cash. That means cash is going out. So you'll credit cash or bank to 25,000. That is one. Okay. Then you lost significant influence. No? So significant influence ka loss of few things you need to do. Right now we have recognized two OCIs. All this OCI, if you have to transfer it either to P&L or retained earnings. So this OCI has a credit balance, because initially to recognize this OCI, what journal entry you would have passed? You would have passed the journal entry investment in associate account debit, because when associate company reports OCI, investment balance will reduce. So investment account debit to OCI R and OCI NR you would have written. Yes, correct. So OCI R was 100 and this was 50. This entry you would have passed. Now you have lost significant influence, means you need to reverse it. Okay. But this OCI, you will not transfer it to investment, because investment is already derecognized. This R OCI will be transferred off to P&L account. NR wala OCI will be directly transferred off to retainer. So you need to reverse, so you need to debit them. That's what they've done over here. This is foreign currency translation reserve, which is your OCI R. PP revaluation reserve, which is your OCI NR. So that you need to transfer. This R will be going off to P&L account. So you'll credit your P&L account. Okay, this only 100 will go off to P&L. No, so you lost significant influence and you made a gain of 150. No, so totally 250. We already found out over here. Total gain to SPL is 250. 250 you'll transfer it off to SPL. Then this non-recyclable OCI of 50 will be directly transferred off to retained earnings. So this is your journal entry that you'll pass in your consolidated financial statement, like that. So basically, whatever investment you're showing, you need to derecognize. Loss of associate wala, significant influence wala accounting you need to do. When you get control, whatever you need to do, that you need to do. When you get control, basically you have to record subsidiary net assets, goodwill, bargain purchase gain, NCI, etc., etc. All that accounting needs to be done. So this is like more like yeah, a point. It's CSK versus RCB today. Yeah, definitely. We'll see. Currently CSK versus RCB is going on, Damacha. Yeah, that will go after 7:30. Already ours is going on. And I think one cup, Isala cup namdu already happened. Yeah. Alright, another cup will happen or not, we don't. But it's okay. On the other side, it is Tala, Dhoni, so it is fine. Yeah, whoever wins, not a big deal. Everything is us only now. Yeah, it's a victory only. Yeah. So with Dhoni, there is no compromise. Yes. Yeah, you deep down, yes, I may be an RCB supporter, but most of them will also be like a Dhoni supporter. So that is like almost equal there. Okay, come back to the questions. I think this is done. Next is what, Pa? I think next I think we need to load one or two more concepts. Then we'll take up the remaining questions. All right. So there is something called common control transaction. Common control transaction means before business combination and after business combination, control is the same party. Before BCom, before business combination, and after business combination, control is with the same party. So how, sir? Look at this example. let's say before business combination, A Limited had 100%. A Limited had two subsidiary company. They had 100% in both A, B and C. They did some reorganization. What happened? Sold. A didn't want to control both the companies. So they did some reorganization. What A did was 100% of C Limited ka share, they sold it to B Limited. 100% of C Limited ka share. Right now A had 100% in C, no? All that C Limited ka share, A Limited sold it off to B Limited. That means after reorganization, what does the flowchart look like? A has 100% in B, B has 100% in C. Correct? No. So that means now you really think over here. Is this really a business purchase or is just a reorganization? It is just a reorganization. Why? Sir, earlier, who used to control B and C? A only. Now also check, A controls B and with the help of B, A controls C. That means ultimately now also who's controlling both the companies? A only. So before business combination, now A sold the shares of C to B. So that's a business combination, right? But before and after business combination, the control is with the same party. If such is the nature, means we call such a transaction as common control transaction. Okay. This in your CA entry used to call it as merger method. Here we have become a little more sophisticated, fancy. Hence the term is common control transaction. Okay. Now, if you just apply your basic mind, in fact, you already know under merger method, sir, we use fair value or we use book value. Under merger method of amalgamation, we always used to use book value. The reason is this really a business combination? Is this really a business purchase or is just a shuffling? It is just a reorganization. It's not really a sale of business. That's the reason what IND AS 103 says is, if it is a common control transaction, right? Correct? Don't use fair value. Use only book value. That is the first rule. Don't use fair value. Normally for business combination, you have to use fair value of assets and liabilities of subsidiary company. Yes, this is not really a business combination. It's just a reorganization. Hence, you may call it as business combination, but accounting of this is done through book value. That's one of the reasons. Okay. All right. So how the accounting should be done? I've written a small extra graph. The same thing. We used it and solved a lot of questions in our regular class. So yeah, we'll quickly run through this and maybe apply it in one or two problems today based on how much time we have. Okay. All right. So first, sir, check whether the common control transaction is whether for a division sale or a whole company sold. Sometimes even, sir, let's say one company has two divisions. One division is doing extremely well. Another division is making heavy loss. One company, they're having two divisions. One division is doing good. Another division is doing bad. So whatever division that was making loss, we sold it. So that means a division sale. So whenever in case of common control transaction, check have you sold the whole company? Is it a whole company sale or a division sale? Okay. So how would it become a common control transaction if we sell it? I'll tell you to in the problem. It's easy to understand with numbers. Okay. So common control transaction could also be for a division sale. So if you have sold a division means now this particular company which has sold this division, can they show? Currently they are already showing this division assets and liability. After sale, can they show it? No. That means they have to derecognize. They're showing it at what value? Carrying amount. So they will cancel or derecognize at what value? Carrying amount or book value itself. So in case of a division sale, what will the selling company do is they will derecognize all the liabilities and assets. Liabilities have credit balance, you will debit it to cancel. Assets have debit balance, to cancel it we will credit. So the journal entry will be liabilities account debit to assets account. Balancing figure you transfer it off to capital reserve account. And on the debit side, if it comes, you can use loss of reconstruction. We can't use P&L account here because due to this particular transaction, distributable earnings should not change. So this adjustment will be done through capital reserve only. Ideally it will match, but if you're getting any balancing figure, put it off to capital reserve. This is for the selling company. What about purchasing company? They acquired some assets, so they have to record assets. They not only acquired assets, they also acquired liabilities. So what entry they will pass is assets account debit, liabilities account, because they have to record the asset now because they purchased the business. So assets account will be debited, liabilities account will be credited. At what value? At book value itself, because it's a common control transaction. Fair value will never come into picture for the common control transaction. Asset will be recorded at book value, liabilities also will be recorded at book value. So purchasing company means obviously they would have given some PC, right? To buy this assets and liability, they have given PC. PC could be given generally in these things, in these transactions, PC will be given in the form of shares. That means they will credit equity share capital. If shares are given by chance at premium, you will credit security premium, if at all it is. Okay, sir. If this journal entry doesn't match, then purchasing company has made either a profit or a loss, right? So normally if purchasing company has made a loss, we call it as goodwill. If they made profit, we'll call it as capital reserve, bargain purchase gain. But in common control transaction, whether it is a loss or whether it is profit, you will debit capital or you will credit capital reserve only. You will not debit goodwill. If it's a loss, ideally you should debit goodwill. If it's profit, ideally you should credit capital reserve. But in common control transaction, you should not use goodwill, but you should only use capital reserve. So why, sir? Sir, if you debit goodwill, so is it really a business purchase or just reorganization? It is just a reorganization. So when you do reorganization, if you record goodwill, it will amount to self-generated goodwill. So this will amount to self-generated goodwill. Hence, in common control transaction, we never record goodwill. So the balancing figure doesn't matter which side it comes, you'll record it as you'll record balancing figure as a capital reserve. Doesn't matter whether it is debit side or credit side. That's the thing. Okay. This is for the division sale. So let's do one thing. Can we quickly apply this in one of the problem? Okay, question number 30. So let's go over this common control transaction division sale with the help of this particular problem. An enterprise has two divisions, laptop and mobiles. Division laptop. Okay. Laptop division basically has been making consistent profit while mobile division is suffering losses. So mobile division is making loss means probably mobile division will be sold off, I think. So this is mobile division ka data. Yeah. So they've given the division wise data also. Laptop ka, mobile ka put together, it becomes company ka. So this is your division, mobile ka, division ka data. So what happened to that? Check. Division mobiles along with assets and liabilities were sold for 25 crores to Turnaround Limited. This whole division of mobile, no sir, it was sold to one company called Turnaround. For how much value? 25 crore rupees. So 25 crores is a PC. Yeah. But this Turnaround company is a new company. This Turnaround company is a new company. That means, are there any shareholders in this? No. That means this Turnaround company will issue shares now to whom? To the seller. Who's the seller? Enterprise Limited. That means what, sir? Who will control this new company turnover now? Enterprise Limited only will control. Sir, earlier if you check, who was controlling laptop division and mobile division? The company only was controlling. Yes, both the division. Now there is another company called Turnover Limited who acquired this mobile division. And this Turnover Limited also is controlled by whom? All the shares of Turnover Limited is held by Enterprise. That means Enterprise only will control turnover now. That means Enterprise only indirectly controls this mobile division now also. Correct. So this is your division sale under common control transaction. Even before business combination, Enterprise only was controlling mobile division. Even after business combination, Enterprise only is still controlling the mobile division. Okay, but in the name of turnaround, that's all it is. Okay, fine. So hence this is the division sale and it's a common control transaction. That's the reason. So if it was not a new company, then it will not be a common control transaction. Or they should issue enough number of shares that this enterprise should be able to control Turnover Limited. Like that. Those they have to structure like that instrument. Okay. Alright, who allotted 1 crore shares of 10 each. So total PC is 25 crores. They allotted this PC in the form of shares. 1 crore shares of face value 10 each. That means equity share capital is 10 crore. I think balance is premium. 15 rupees premium. So 15 crores, 10 crores is the equity share capital. 15 crores is security premium. Okay. One of the members of enterprise of holding 52%, all that is saying, okay, pass the journal entries in the books of Enterprise Limited. So Enterprise Limited, what did they do? All mobile division in fact entire mobile division they sold. So you need to pass journal entry. What journal entry, sir? Assets and liabilities you need to derecognize. That's all. Okay, what is the journal entry for this one? All the liabilities you need to debit, all the assets you need to credit. What are the liabilities of mobile now? One is loan fund 300, another one current liability 400. Have they debited? Yeah. Then asset. Actually, they are showing accumulated depreciation also. Accumulated depreciation has credit balance. To cancel it, we have to debit. So we have to debit provision for depreciation or accumulated depreciation also 400. Then PPE ledger balance has 500. So you will credit by 500. Then any other asset is there? Yeah, we have current assets 500. So you will credit current assets 500. If it doesn't match balancing figure, you will show it as capital reserve. So in common control transaction, you should not write P&L because the earnings should not change. Due to this common control transaction, your distributable earnings, as in your P&L, should not change. That's the reason balancing figure, you put it under capital reserve wala scenario. Okay, this is the journal entry for Enterprise Limited. After this, they are asking balance sheet. Sir, what is there in the balance sheet, sir? Cut off this data. This data only will become new balance sheet. That's all. So all this you need to reduce. That's all. They're asking you to prepare a new balance sheet. So only mobile division ka data entirely you ignore. Only consider laptop division, that will become your new balance sheet. That's all. Okay, that is child's play. Yeah. Next is what's the prepare balance sheet of turnaround. So let's also pass the journal entry for turnaround. What will be the journal entry for turnaround? They acquired mobile division assets and liabilities, no? So they have to record all the assets. What and all assets they required? And again, since it's a common control transaction, we will not use fair value, but only book value. So what is the book value of PP? 100. We will not write depreciation. It's a new company, no? They have not yet started depreciation. So you will take over the PP at net block, the WDV value, which is 100. So PP will be recorded at 100. Any other asset is there? Yeah, we have current assets 500 of mobile division, which will be recorded. Excuse me. Yeah, that is one. Then Liabilities. Liabilities, one is current liability 400, loan funds 300. 400 and 700 have they shown up? Yes. So to get this control, to get all this, Turnover Limited gave PC. What did they give PC? 1 crore equity shares of 10 each. So they will credit equity share capital of 10 crore, security premium 15 crores. If the journal entry doesn't match, balancing figure, you will either debit capital reserve or credit capital reserve. Goodwill should not be shown. Here you're getting balancing figure on the debit side, so you show capital reserve. Okay. So when they ask you balance sheet of Turnover Limited, keep in mind the other equity portion. Okay, capital reserve has a debit balance. So just because it has debit balance, don't show it on asset side. It will still come under other equity only, but as a negative balance. So capital reserve is 125 negative, security premium is 15 positive. So 125 minus 15 if you net off, the other equity ka balance will be 110. That's what they've shown over here. They prepared a note for it, but I'm just saying. All other assets same. PP you'll record it at 100, current asset at 500, the current liability at 400, I think that is given in the next page. This is 400 and 300, equity share capital at 10. So this only is your balance sheet. You'll have to plug it in the normal format. That's all. There goes your balance sheet. Okay, sir. So this is for common control transaction where only division has been sold. Is it necessary that every time we should sell division only? No. We could sell the whole company also. Sir, if whole company has sold, then what to do, sir? I'll show you that as well. First, we'll run through a few pointers. Then we will apply it to the one question. Okay, so it's a common control transaction, but whole company has been sold and not just the division. So in this case, what to do? Sir, if whole company has been sold means every single ledger of the selling company needs to be closed, right? So all the assets should be credited, all the liabilities, other equity share capital, they have to be debited. All this has credit balances. To close, we have to debit. Obviously, everything will be debited at book value only. All the assets has debit balance, and to close, we will credit it. That's all. So ideally, in these sort of transactions, there will not be any balancing figure. But companies close, no. So they should not get any balancing figure in this case. That's the reason. So every single ledger should get closed. So it will be closed off here like this. So this is in the books of the selling company. What about purchasing company? No, they have purchased the business means they will get the subsidiary they will get all the assets and liabilities of the acquiree. So they will record all the assets, liabilities, not only assets and liabilities, even other equity, line by line item, everything will be picked up. Okay, everything, assets, liabilities of the selling company, other equity of selling company also will be picked up and shown by the purchasing company at book value. So asset will be debited at book value. All the liabilities will be credited at book value. Other equity will be credited at book value. So why not share capital, sir? So share capital belongs to selling company. Selling company is shut down now. Okay. So instead of this, they'll have to issue PC, right? So don't credit share capital of selling company. That will not be taken. Yes. Then what's the, to buy this, to acquire this company, they would have paid PC, right? So generally in these sort of transaction, because it's common control transaction, PC will be given mostly in the form of shares only. So you'll write what? To equity share capital to securities premium, the PC portion. Okay. Balancing figure is either goodwill or capital reserve. No, you can't write goodwill because it's still a common control transaction. So balancing figure, you will debit capital reserve itself. So goodwill should never be used in common control transaction. Keep that in mind. Okay. So that's about this. Okay. All right. Next one more you need to remember is, maybe we'll run through this chart as well. And then we have one or two questions directly. We can take care of that. So what is this is, what if PC is not given in the problems? Sometimes what happens, the purchase consideration will not be mentioned in the problem. So in that case, what to do? So if purchase consideration is not given in the problem, first check whether it's a common control transaction or whether it is a normal transaction. Normal transaction could be your not a common control transaction, or there is something called reverse acquisition also. Okay, we'll talk about that in a bit. Okay, first check whether it's a common control transaction or others. If it's a common control transaction, then PC you can calculate, or you'll get PC like this. PC is given by assets at book value, all liabilities at book value minus other equity at book value. All the assets of the selling company they would have given, take them at book value. All liabilities of selling company you adopt at book value minus other equity at book value you take. Assets minus liability only, we call it as net assets. Or you can restructure this as PC is equal to net asset at book value minus other equity at book value. Or net asset minus other equity, if you do, what else remains? There's nothing but paid up capital. So in common control transaction, if PC is not given, PC will be equal to paid up capital of selling company. Whatever is the paid up capital of selling company, that itself will be PC. That is one. So what if we have more than one selling company? Sir, if we have more than one selling company, whatever PC you got, sir, this PC, if there are two selling company means, find out both the company ka PC, add them up. You will get total PC. The total PC will be distributed to the selling company in their net asset wala ratio. the total PC will be distributed to the selling company in net asset wala ratio. Okay, so this is what you need to keep in mind for. This is about common control transaction if PC is not given. So however, if it's or let's do a thing, let's stop here. I think there's one question. We will keep the equation, with this equation we have studied, only this part of the equation there is one problem. So we'll do of that and then maybe come to the other side of equation. So what did we learn over here? If PC is not given for a common control transaction, what to do? So indirectly, what is it? Take assets at book value of selling company minus liability at book value minus other equity. Or another way to reconstruct equation is PC is equal to net asset of selling company ka at book value minus other equity at book value you take. Or indirectly, PC is equal to paid up capital. So if more than one selling company is there, this particular PC, find out total PC, and total PC will be distributed to all the selling companies in their respective net asset wala ratio. Okay, so let's take question number AX and BX wala question. Question number 33. AX and BX amalgamated from 1st January 20x2. A new company ABX was with shares of rupees 10 was formed. So it's a new company. Okay, so it's a new company means who will control it? Whoever has maximum shares in the new company will control it. Okay, so let's see what it is over here. A new company was formed to take over the business of existing company. So this ABX company, the new company, will take over AX ka business and BX ka business. Both the business they will take over. Okay, balance sheet of both the companies they've given. Great. So simple balance sheet they've given. Then they've given a notes to accounts. The other equity breakup. We have this many other equity. Then they're saying ABX issued requisite number of shares to discharge the claim of equity shareholders of transferor company. Required number of shares is given to the transferor company as PC. That's what they're trying to say. Okay, fine. Also, the new debentures were issued in exchange of old series of both the company. I think both the company already has some debentures here. Since both the companies are selling company, are liquidating. So obviously, what will the debenture holder say? Either settle our money in the form of cash or give new company ka debentures. So selling company ka debentures has been exchanged with the new company ka debentures. It's a simple barter transaction. That's all. Value is same. Okay. That even if they don't say, it has to happen. All right. Now what you need to do, assuming that both the companies are under common control. So you need to prepare, so you need to show PC and you need to prepare balance sheet under 3 scenarios they have given. First scenario is assume but both the entities are under common control transaction. Okay. So if it is a common control transaction, what you need to do? So first of all, do you know PC? Anywhere they told PC, that's all. Don't read the other 2 pointers. It's a separate scenarios. Okay. So if you just say, they said requisite number or required. Requisite means required. Required number of preference shares will be given. That's all they said. But how much is given? Did they mention? No. Is it a common control transaction? Yes. Is PC given? No. PC is missing. So what to do? So if PC is missing, the first thing you'll do is what, sir? Find out the PC. How? Multiple ways. So in fact, 2 selling companies are there over here, right? So one way to calculate PC is what? One equation is assets of the selling company at book value minus outside liabilities minus other equity you do. Or another way, net asset at book value minus other equity at book value, or paid up capital itself will become your book value. Yes. So do you know the paid up capital of AX Limited? Yeah, paid up here. Where is that? Paid up equity share capital of this is your AX. Yeah, first company is AX ka data, then it is BX ka data. AX ka paid up equity share capital is 6,000, BX ka is 7,000. This only is your PC. Yes, that's what we have given over here. All right. Yeah, I've showed you the calculation. But what is the total PC? Because there are 2 selling companies. Find out the total PC, which is 13,000. What do you do? What should you do for this total PC? It should be distributed to both the companies in their net asset ratio. That's the reason I also found out net assets here. Okay. So how do you get net assets? All the assets at book value you take. So basically all this you add. In fact, every asset at book value. No. So let's start with total assets. What is the total assets? 13,050 and 15,200. That is the total assets. From total assets, you have to just reduce the liabilities. What are all liabilities we have? This one. Other equity, we'll reduce it later. First is because we want net assets. How do you get net assets? Assets minus only outside liabilities. So these you reduce. So 3,000, 4,000, 1,000 and 1,500. That's what I've reduced. In fact, I've totaled all the outside liabilities and I've reduced it. I've shown here. Then you'll get net assets. Net assets minus other equity will give you your PC. This way what happens in this working note, I got PC also, I got net asset also. So what is the ratio of net assets? 9,050 is to 9,700. So total PC of 13,000 will be distributed to both the companies in that 9,050 and 9,700 net asset wala ratio. So how much PC AX will get? The PC of AX will be 13,000 into this ratio. If you do, you're going to get 6,275. What about PC of BX? They will get 6,725. That's the thing. Okay. So there's a common control transaction and we found out PC. Now they're asking you the balance sheet. Common control transaction balance sheet is very, very straightforward, sir. Because No fair value adjustments, nothing. Every assets and liability at book value, no. Simply take book value of both the company ka assets and just prepare up the new balance sheet. Just go on adding the assets, that's all. So this is 8,500 plus 7,500. Okay, that's what I've shown here. Investment also go on adding. All the assets and liabilities go on adding. Just don't add equity share capital, that's all. Okay, this all assets you add, this you don't. In fact, this also here you can add because total PC is 13,000 only, no. So except that you are not taking over shares of the selling company, you are issuing new shares. The new shares are issued to what extent? 13,000 extent. So everything, every line item in the balance sheet, whatever they've given, one by one you need to add, that's all. And put it in the same format, that's it. What about NCI, sir? 100% acquisition, nothing about, if they say simply it is acquired, it is always 100% acquisition. If they don't give the percentage, it is always 100% acquisition. So if NCI is there, they will clearly specify that the parent has acquired only 70%, 80%, like that. They will mention. Percentage not given, 100% acquisition. So that's all. This is a very, very straightforward question. Yes, no, only thing is you need to keep in mind the PC element, right? So PC in common control transaction will be nothing but equal to your paid up capital. Okay. If there are more than two companies, find out the total PC and distribute it in net asset ratio. That's the only thing that is a takeaway of this particular question. The rest everything is pure formatting things. That's all. Yeah. Okay. This is one part of the problem. There's another part, but before that, we'll come to the next leg of our chart. Let's cover that and then take up the next question. Okay. Sir, however, if it is not a common control transaction, if it is not, PC is not given, but it is not a common control transaction, it is a normal business combination or it's a case of reverse acquisition. What is reverse acquisition? I'll tell you. Okay. So if it is a normal business combination or reverse acquisition and if PC is not given, what to do? Sir, check, sir, in some problems, they will directly give you fair value of business. The selling company ka fair value of their business, fair value of business of selling company will be given. Check if that is given. If that is given, that itself becomes your PC. The fair value of business of selling company, if it is given in the problem, that itself becomes PC. Sir, if that is also not given, sir, they will give you fair value of net assets, or they will give you data through which you can calculate fair value of net assets of selling company. Net asset means the net worth of the company, right? So yes, so if you can find out the fair value of net assets of selling company, in that case, that will become the PC. So if fair value of business is given, directly take that only to be PC. If that is missing, then they will give you some fair value data through which you can compute fair value of net assets of selling company, and that fair value of net assets of selling company will become your PC in this particular regard. So if PC is not given, this is what you need to do. This will apply it in the same question. The question that we did now had 3 parts. Only one part we have covered. Other 2 parts has these concepts. That's the reason I want to cover this first, then apply that in the very next question. Okay, this is one. So what is reverse acquisition now? So reverse, name itself is saying reverse acquisition. So let's take a small example. Sir, A Limited acquired 90% of B Limited. So that means what? Obviously, A Limited is the acquirer, meaning A Limited is the parent, B Limited is a subsidiary company. Yes, no? Looks like A Limited is the acquirer. Yes, but check, not necessarily. Okay, A Limited may not be the acquirer. He may also become acquiree. Name is reverse acquisition. Keep that in mind. Yeah. So A Limited acquired 90% of B Limited. Sir, before acquisition, A Limited has 50 shares. I've taken a smaller number for example's sake. A Limited in their company, they have 50 shares before this particular transaction. Okay. B Limited had 100% shares. Okay. Now, if A Limited has acquired 90% shares of B Limited, means they have to get control, they have to give PC. Let's say PC was given in the form of shares. And shares, no sir, they've done in a ratio exchange. What ratio exchange? 3 shares of A Limited will give, or 3 shares of A Limited will be given for each share of B Limited. So if A Limited acquires 1 share of B Limited, they will give 3 shares. That is what is acquired. For every 1 share acquired, they will give away 3. That's what they agreed. So how many shares B Limited had? 100. Entire 100 shares A acquired or only 90%? Only 90%. That means number of shares acquired is how much? 90. 90 shares of B A has acquired. And how is A, what is A giving for those 90 shares? Are they giving PC in the form of cash? No, PC is given in the form of shares. What shares? For every 1 share acquired, we will give 3 shares. So here we are acquired 90 shares. That means how many PC will give? For 1 it is 3, means for 90 it will be 90 into 3, which is 270. So A will issue 270 shares as PC to B Limited, correct? Now check, sir. How many shares are there in A Limited now? Before this transaction they had 50. Now they've issued 270 more. So totally they have 320. So check, do a quick checkpoint. Who and all owns this 320 shares? In this 320 shares, 50 shares, existing shares, is held by some other party, third party. We don't know. Alright, 50. Who holds this 270 shares? B Limited, correct? Now check the percentage, sir. What is the percentage? Out of 320, B Limited or B Limited owners own 270. That means the percentage is what? 84%. I've rounded it off this for simplicity. You get some 84 point something or 83 something, which I've rounded it off. And others own about 16%. Now you check, sir. Who's really controlling whom? A is not controlling B. Indirectly, B is controlling A. On paper, no, it says A has acquired B. But in reality, B Limited ka owners, not B Limited, actually B Limited ka owners is controlling A Limited. Yes, now earlier, or just to avoid the confusion, I can say earlier B Limited ka owners were controlling B Limited. Now PC is given to B Limited ka owners. Correct? Now what is happening? Earlier B Limited was controlled by B Limited ka owners. After this transaction, B Limited ka owners control A Limited, and through A Limited they control again B Limited. So that means what? What is happening over here? So on paper, it is saying A has got the control of B, but in reality is B has control. We don't do all the accounting for B Limited owners, right? All the accounting we do it for B. That means indirectly what is happening here? B has acquired A. Legally it says A has acquired B, but in reality B has acquired A. Such a scenario we call it as reverse acquisition. And if there is a reverse acquisition, sir, what we need to do? Very simple, sir. So IND AS 103 and all runs not on a paper-based accounting. It's not based on legal form or whatever based accounting. It's substance over legal form accounting. Most of the standards are. Meaning reality is important than legality. That's what in layman terms it means. In real terms, what it reflects. Transaction reflects what? That we need to account. Like on paper, A has acquired B Limited. That's what legally the document is saying. But in reality, is that so? No. Reality is what? B has acquired A here. That means based on the reality, you will do the accounting. Okay. So in here, no, there will be two acquirers. As per paper or as per legal, one is acquirer. As per legal, who is the acquirer? A Limited. So A Limited, we call it as, in this case, A Limited, we call it here, or maybe I'll use a different English, 1 second. A Limited here, we call it as legal acquirer. That is on paper. But really, who's the owner? B Limited. B Limited, we call it as accounting acquirer. So accounting and all this accounting, etc. disclosures, we make it from accounting acquirer perspective. So this B Limited, accounting acquirer is basically the real acquirer. So who's the real acquirer here? B Limited. So we do the accounting from the real acquirer perspective. Now you tell me, sir, here really what has happened? B has acquired A. In reality, I'm not talking about legally. Reality, what has happened? B has acquired A. That means what? What will happen to B Limited ka balance sheet items? B Limited ka balance. So if parent has acquired subsidiary means, will anything happen to parent ka assets? No. Parent ka asset will stay as it is. All subsidiary ka assets, parent will show at fair value. Correct? So here who's the real acquirer? B Limited. B Limited ka all the assets, liability and other equity, reserves and surplus will be shown at book value only because they are the real acquirer. Real acquirer ka assets, liability, equity will not change. That means they will come in book value only. What about accounting? What about legal acquirer? Legal acquirer is the acquiree. Legal acquirer is really the one who got acquired. So, right? So this is like a subsidiary. So what do you do for subsidiary? Subsidiary company, all the assets and liabilities will be taken over at fair value. Other equity like reserves and surplus only, we call it as other equity here, right? That will be ignored, meaning it will not be taken over. That's a case of reverse acquisition you need to keep in mind. That is what will happen in that problem, the next scenario. Okay. So again, just to be sure. So legally, in this example, A has acquired B, but in reality, B has acquired A. So A we call it as legal acquirer. B we call it as accounting acquirer. Accounting acquirer is a real acquirer and we do the accounting from their perspective. So this is really the parent and this is a subsidiary. B is a parent and A is a subsidiary. Think like that. What will happen to parent ka assets, liability, other equity? It will stay at book value. That's what I've written here. Accounting acquirer ka assets, liability and other equity will stay at book value. Okay. What about A Limited? A Limited in reality is a subsidiary company. Subsidiary company assets and liability, we only take over assets and liability, not share capital and other equity. Only assets and liability of subsidiary company will be taken over and recorded at what value? Fair value. So A and B ka assets and liability we take over at fair value. We ignore the other equity. That's all we need to do. Okay. All right. So let's come to the same question now. Same AX and BX wala question. They've given balance sheet. Okay. So they've given fair value of business and all that. Here, 1 second. No, I think that's not given. Now check second scenario. So first scenario we've already done. Second scenario. Assume BX is a larger entity. AX and BX was a selling company. ABX was the acquirer company. That's the transaction over here, right? AX and BX, existing company. New company ABX has acquired AX and BX. That's what legally it is telling. Now they've given another separate scenario in B. What are they saying? Assume BX is a larger entity and under their management will control the entity ABX. On paper they are saying ABX has acquired AX and ABX has acquired BX. This is as per legal document. But reality is they are saying BX has acquired ABX and BX is controlling AX. That means what, sir? Legally they are saying AX has acquired BX, but the reality is BX has acquired ABX. That means this is a case of RA, as in reverse acquisition. Okay, so second scenario is a reverse acquisition, and they have also given further data for this. Fair value of business of AX and BX they have given. Okay, certain assets ka fair value they have given, and fair value of business also they have given. Okay, now you tell me what is the case over here? ABX is just a dummy entity. In reality, what has happened? BX has controlled AX Limited through this particular transaction, but it is routed through a new entity called ABX. So ABX is just a dummy. Leave that out. But the real transaction or real deal is what over here is BX has acquired AX. Okay, so BX is the real acquirer. Do you agree with me? Yeah. Real acquirer ka all assets and other equity will stay at book value. Acquiree ka, that is AX ka, assets and outside liabilities, not other equity, only assets and outside liability will be taken on at fair value. That's the reason they have given you some fair value adjustment. Okay. Again, if you check the problem, PC they have not given. So if PC is given, what to do, sir? Is it a common control transaction? No. In common control transaction, if PC is not given, we make PC equal to paid up capital. Here, is it a common control transaction? No. It's a case of a reverse acquisition. In normal business combination and reverse acquisition, if PC is not given, what to do? Check if fair value of business of selling company is given. In reality, who's the seller here or who's the acquiree here? AX. Do you know AX ka fair value of business? Yes. Which is how much? 11,000. So that means this itself becomes your PC. Okay. So that's what we'll start it over here. One second, I'll get this a little closer. So PC that not given. Okay, that's what I've written over here. Accounting acquirer is BX Limited. Legal acquirer is ABX. It is routed through an entity called ABX, but in reality, the acquirer is BX Limited. So PC is a selling company. Which is a selling company? And really, who's a selling company here? AX. Do you know the fair value of business of AX? Yes, given as 11,000. So that itself will become PC. Okay. Now this PC, who will give? The real acquirer. Who's the real acquirer? BX. Okay. So now, do you know the fair value of business of BX Limited? Yes. So BX has to give totally 11,000. They will give this 11,000 in the form of shares. So how many shares for accounting we're trying to find out now? What is the fair value of business of BX Limited? 14,000 given. Right? Sir, do you know how many shares does BX have? Yeah, come back. BX ka share capital is 7,000 and each share ka face value is 100. That means how many shares BX has? Number of shares of BX is 7,000 divided by 10, which is 700. Correct? Huh? Yes, people. Now you just check, sir. BX has totally 700 number of shares. Maybe all these numbers are in lakhs or thousand. Let's not worry about that. It's fine. Okay. The total business of BX, fair value of business of BX Limited is 14,000. All the shares put together of BX, his value is 14,000. And we have 700 number of shares. All the shares put together of BX value is 14,000 and they have a number of shares of 700. So that means what is the market value of each share of BX Limited, the acquirer? 14,000 is the total value of all the shares and they have 700 shares, means the value of one share will be 14,000 divided by 700, which is 20 rupees. The value of one share of BX is 20 rupees. How much PC BX has to give to the AX? 11,000. How will this be discharged? Not by cash. All this is reverse acquisition routed through shares. So 11,000 totally we need to give and the fair value of one share is 20 rupees. So how many shares will be rolled out? 550. Okay. That means what will be the share capital? Market value is 20, no? But the fair value of the shares is 10 rupees. They only told in the problem face value of each share is 10. Correct? You're issuing totally 550 shares, but you're issuing it at 20 rupees indirectly. All this has not happened. This is like substance over legal form accounting. You'll think that this is what has happened and do the accounting over here in case of reverse acquisition. Yes. So 550 shares, you have to think that BX has issued to AX at an issue price of market price, which is 20. But the face value of each share is 10. So 550 into 10, because equity share capital always shown at face value. So 550 into 10 will become 5,500. The balance element, 10 rupee worth of shares, you give it for 20 means balance will be premium element, which will be 5,500. This has not happened, sir. Okay, in reality, ABX, the new company, is issuing shares. Okay, but you have to do the accounting. In case of reverse acquisition, you have to think like this and do the accounting, do the presentation. There's only notional accounting. Yeah, all right. So this is about equity share capital and security premium. Okay. So is it a common control transaction? No. That means has business acquisition really happened? Yeah. Business acquisition has really happened. The only confusion is who has acquired who. But in reality, business has been acquired. I mean, now will you show goodwill? Yes. Only in common control transaction, you don't show goodwill. Here you have to show goodwill. How do you calculate goodwill? Same way. First calculate what, sir? We need fair value of net assets. First, let's find fair value of all the net assets. Okay. Some of the assets where the fair value is different, like they have given in the problem here. Whose fair value you have to take? Fair value of business of the seller. Who's the seller here? AX. So only take AX ka fair value, which is PP is 9,500 and inventory is 1,300. Okay, these two are fair value. Rest of the assets do not have any extra fair value. That means their book value and fair value will be assumed to be same. So copy all the rest of the assets ka. Here they've given balance sheet. No, rest of the assets ka value you copy as it is. These are all book value, and book value will be equal to fair value for all other assets and liabilities. Only take assets and liabilities. Don't take other equity. Okay, only these two assets had fair value in the adjustment which we have taken. Rest of the assets and liability data you copy from balance sheet. So assets minus liability, if you do, you're going to get fair value of net assets on the date of control. Now, how do you get goodwill? First, you have to take the PC. How much is the PC, sir? We already got it over here, 11,000. There is no NCI over here. Okay, they've not given anything. So NCI is 0. So PC plus NCI minus fair value of net assets. Fair value of net assets, we just now got it to be 10,100. So that gives us what? 900 positive number, which is nothing but your goodwill. This goodwill you have to show in your consolidated balance sheet. How do you prepare consolidated balance sheet? Keeping rules in mind. It's a reverse acquisition, mind you. So who's the real acquirer? BX. So all the data of BX will come at book value. What do I mean by all the data? Their asset, BX ka assets, BX ka all liabilities, and BX ka equity and other BX ka other equity. All that we'll see. Basically, will be reflected at equity and other equity, to be honest. Okay, everything will come at book value. BX ka data, nothing will be there. Whatever is there in the balance sheet, copy the same thing in consolidated balance sheet also, because they are the real acquirer. Parent ka data will not change. What about AX? AX is the acquiree. He is a subsidiary, or they are the subsidiary company. Subsidiary company ka you will take over what? Other equity you will take over? No. Equity share capital? No. You will only take assets and liability. That too at what value? At fair value. But here the problem is the only two assets have fair value. Rest of the assets ka fair value and book value are same. So if you just check over your PPE ka. So when you do consolidated balance sheet, first when you do PP, AX ka you will take it at 8,500. No, you will not take 8,500. 8,500 is book value. Do you know the fair value of PP? Yes, it is 9,500. So you will take 9,500 of AX. This is fair value, and you will take BX ka book value. Check what is the book value given in the balance sheet? 7,500. Like this, you will go on adding. Okay, sir. Alright, only inventory also extra has a fair value. Rest everything is ditto. Directly go on adding there. Okay. Good. Do not forget to show goodwill. Okay, that's one thing. And here there is no NCI, so there is no drama around that. But when you come to share capital also once maybe I'll show. What is the share capital, sir? Share capital of BX will stay as it is, 7,000. To the 7,000, what you do? I've already showed you how much is the equity share capital. We already wrote it here, which is 5,500. PC is given in the form of 5,500, we'll say. So BX already has a share capital of 7,000. To this, you will add 5,500. So that means the share capital will become 7,000 plus 5,500 will become 12,500. That is one. Okay. And when you do other equity, do not forget to show securities premium. And don't include AX ka data. So when you do an actual business combination, we only take over subsidiary ka assets and liabilities. Don't take over other equity. AX ka other equity will not come. These are all other equity of BX only. Okay. Only BX ka other equity that they've given over here. Check. That's all I've taken. 2,500, 100 and 100. That's what I've shown over here. 2,500, 100, 100. One security premium extra was there. That's all. Rest everything will be only other equity of the real acquirer will come. Subsidiary ka or acquiree ka other equity will not get reflected. That's all. And here they said this debentures will not belong to the AX or BX. This will belong to the new company, which is ABX. They did a barter system, no? Okay, so that's what it is. But the value is pretty much the same. So all other data just go on adding line by line. That's fine. So overall, if you have to repeat it, just to be sure, what is this over here? When you're in reverse acquisition. So what you have to do is, if they don't give PC, check if the real acquiree, not acquirer, real acquiree, have they given the fair value of their business? So here real acquiree or real seller was AX Limited. Did you know the fair value of them? Yes, it was given, I think, to be 11,000, right? So you'll think that the PC of 11,000 will be given. Who's a real acquirer? BX. So you have to think that BX will give PC to AX to the extent of 11,000. And how this PC will be given in the form of shares. That means you need to know one share value of BX Limited. To find out that, what do you do? I think fair value of business of BX also is given. Number of shares of BX also you know. Fair value of BX was 14,000 and they had 700 as a total number of shares. Total worth of all the share was 14,000 and total number of shares is 700, means the worth or the market price of one share is 20. So this 11,000 will be discharged by BX by issuing shares at an issue price of 20. So shares are issued at premium, but share capital will always be shown at face value. So number of shares will be 11,000 divided by 20, which is 550. So in that 550, the face value of each share is 10. So share capital may you show 5,500. Another 5,500 you will show in securities premium. That's one drama. Okay. Since it's a real acquisition, it's a reverse acquisition, but still it's an acquisition. So goodwill you have to show under your normal calculations. Okay, that's one. And when you prepare balance sheet, the real acquirer, which is BX, their assets, liability, other equity, share capital will be shown as it is, whatever is there. So to this you add what? Subsidiary ka only assets and liabilities. Don't add other equity. Only add subsidiary ka assets and liabilities at fair value. That's all. Just go on doing this adjustment. If there is goodwill, show goodwill. If there is NCI, show NCI. In this problem, there was goodwill, but there was no NCI, hence we have not shown. So that's how you prepare reverse acquisition ka balance sheet. Okay, G. Now anything else, G? 1 minute, sir. Okay, concept, we have done everything. I think we have one more question, so we can kind of run through that. Maybe we'll do this particular question. The balance sheet of Professional and Dynamic Limited on 31st March is as follows. Excuse me. So they've given balance sheet. Okay. Next, some other information they've given. Let's run through that. This is probably important. Professional acquired 70% shares of Dynamic Limited. So with 70%, obviously you get the control. Now, the moment you see 70% Professional is acquired, don't automatically assume Professional is acquirer. It could be a case of reverse acquisition also. Okay. So see the data and accordingly conclude. It's okay. On 1st April 20X2, so they acquired the shares on 1st April 20X2. That means this is the date of control. By issuing its own shares in the ratio of 1 share for every 2 shares held. For 2 they have issued 1. So I don't think so. It will be a case of reverse acquisition. Yeah, because for 2 shares acquired in reverse acquisition, no, for 1 shares acquired, usually more than 1 will be issued out. Generally, okay. If you want, you can test it out after the session is over. All right. So generally that's the case. Here you acquired 2 and you are giving away 1. So most probably it's not a case of reverse acquisition. You can go home and they've anyway given balance sheet. No, you can try that on your own. So it is not a reverse acquisition. It is a normal acquisition. Okay. The fair value of shares of Professional Limited was 40 rupees. You are issuing the shares. No? So you need to know the value of the shares. That's the reason each share ka acquirer ka share value they've given is 40 rupees. The fair value exercised resulted in the following. All the numbers are in lakhs. I think previously also all the numbers were in lakhs only. Okay. Okay. Now the fair value of PPE was 350 lakhs. We know that Dynamic is here Professional is the acquirer and Dynamic is the acquiree. You have to show all the acquiree as in Professional is a parent and the Dynamic is a subsidiary company. You have to take over all the assets and liabilities of subsidiary company at fair value. So they've given this fair value. Okay. So if there is fair value adjustment, you may get some DTA, DTL also. And do DTA, DTL adjustment only if tax rate is given. Okay, in the previous problem also there was some fair value adjustment, but I did not calculate deferred tax asset because tax rate was missing. Only if they give the tax rate, do the deferred tax asset or deferred tax liability wala calculation, otherwise ignore it. Yeah, keep this in mind. Maybe I think I forgot to tell this previously. I think here we don't know, it might come, we'll see. Professional also agreed to pay an additional payment as consideration that is higher of 35 lakh and 25% of any excess profit in the first year after acquisition. Okay, so if they make any excess profit, they're saying of how much ever is excess profit, 25% of that the parent will give as consideration. Okay, I think this is what we'll see. They will give higher of 35 lakh and excess profit over its profits in the preceding 12 months made by Dynamic. This additional amount will be due in 2 years. Okay, this payment will be made after 2 years. That means this is a deferred consideration. Dynamic earned a profit of 10 lakh in the preceding year and expects to earn another 20 lakh. So current year, they have already earned 10. We are expecting to earn 20 lakh. So that means what is the excess profit? The excess profit will be 20 minus 10, which will be 10 lakh. So how much ever is the excess profit? 25% of that they will give. 25% of this excess, how much? 2.5 lakh. So what did they say? The company will give, the acquirer will give either 35 lakh or higher of the two, right? 35 lakhs or this number 2.5 lakh, whichever is higher. So that means the number is what? 2.5 is irrelevant for us. 35 lakh is what the deferred consideration is. That means will deferred consideration form part of PC? Very much yes. But can you take 35 lakh straight away as PC? No, 35 lakh is a future value. We don't want future value. We want fair value. Fair value means what is its fair value today? So this is the payment I made after 2 years. So we have to use a discount factor and get its present value. I think somewhere they must have given discount factor here. 10% is a discount factor. Okay, I think here we need to calculate PC. Let's do a thing as and when we read the data, we'll finish off PC portion. It's easy. Okay. So one is you're paying 35 lakhs after 2 years. 10% is a discount factor. So 1 divided by 1.1. Second year, if you find out, my calculator is showing 0.8264. So multiply, you will get the present value to be 28.93. That is one. That is one component of PC. Okay, next is what I think you gave shares also, no? So they acquired 70% shares of Dynamic. Okay, check sir. Come back to Dynamica balance sheet. What is Dynamica balance sheet value? 400 lakhs. And each share ka face value is 100. That means how many shares does Dynamic have? They have 4 lakh shares. Yes, entire 4 lakh shares professional acquired. No, they acquired only 70% shares. Okay, that means they acquired 2,80,000 shares of Dynamic. Yes, and for this 2,80,000 shares acquired, what did they give? They gave PC in the form of shares. What shares? For 2 shares acquired, old and new will, right? For 2 shares acquired, 1 shares will be given as PC. For 2,80,000 shares acquired, how many new shares will be given? Professional will issue 2,80,000 divided by 2, which is 1.4 lakh shares they will issue. Professional will give its own company ka shares to the extent of 1,40,000. This is not the value, this is a number. Okay, and each professional share ka value is how much? 40. So 1.4 into 40, I think 14 4s are 56. So this is 56 lakh rupees. So you're giving PC in the form of equity shares to the extent of 56 lakh rupees. That's how it is. So you can present in one line here straight away like this. Yeah. Excuse me. I think you can present it like this also, like here. Totally professional had 4 lakh shares. Totally Dynamic had 4 lakh shares. Company acquired, professional acquired 70% shares. So this is 2,80,000. Yes, for this 2,80,000, what did they give? For this 2,80,000, they gave PC in the form of shares. For every 2 shares acquired, 1 share. So divided by 1 by 2, you'll get 1,40,000. So basically 1,40,000 shares have been issued, and each share ka value is what? 40,000. Like that, you simply present it. Instead of like this, you can do it like this. Yeah, that will give you 56 crore rupees. Okay, that is all your PC working. Okay, here multiple components of the PC are there. In addition to above professional limited, the acquirer has also agreed to pay one of the founder shareholder a payment of 20 lakh. The employee shareholder is there. He's a founder also. He's a shareholder also. Okay. So to him, the professional is saying we'll give additional amount. How much amount? 20 lakh. Provided he stays in the company for 2 years after acquisition. Only if he stays, he will get this. Have they told even if he doesn't stay, we will pay? No, like that it is not mentioned. That means what? Only if he stays, he will get it. If he leaves within 2 years, he will not get it. That means is this PCR? No, this amount is given for service. That means this is an employee benefit expense. So book it as employment benefit expense. Don't book it as PC. This will not form part of PC. Okay. So this is not PC. So we don't need this. Next, Dynamic had a certain equity settled plan. So subsidiary has some equity settled plan on the road. We already saw this. Share-based plan exchange. Yes. Okay. Dynamic had a certain equity settled plan award, original award, which got replaced by the new awards by professional. So subsidiary ka share-based plan, parent is replacing it with their awards. So replacement scheme they are doing. As per the original term, the vesting period was 4 years. Okay. And as of the acquisition date, employees of Dynamic have already served 2 years. Original vesting period was 4. In that 2 years is already completed their scene. As per the replaced award, vesting period has been reduced to 1 year. Okay. After acquisition, so the parent is so Dayala Prabhu, so Dayala Karna that they said actually 2 years is over. So employees should wait for 2 more years to get the shares. But the parent company is so nice that they're saying no need to wait for 2 more years, just wait for 1 more year, that is good enough. That means total vesting period they reduced. 2 years is already over. Now the employee have to wait for 1 more year. So that means the revised vesting period has become only 3. They've reduced it. Okay. 1 year from the acquisition date. The fair value of the award on acquisition date is as follows. Original award ka, old scheme ka fair value is 5 lakh, new scheme ka is 8 lakh. What to do for this? So this is prorated as BPR, we need to find. Why sir? Sir, the new company is giving, the parent is giving shares to the employee, but employee has already served for 2 years. That means for the 2 years is parent getting service? No, subsidiary got the service, but parent is not getting any benefit. Still they are giving shares. So that portion of shares is not for service. So that portion should be considered for PC. We call that as prorated SBPR. Okay. Prorated SBPR. How do you get that prorated SBPR? Fair value of original scheme. Fair value of original scheme divided by the original vesting period or revised vesting period, whichever is higher, multiplied by the vesting period completed. Okay, this we have to get. What is the fair value of the original scheme? Fair value of the original scheme was 5 lakh divided by original vesting period was 4 years. Revised vesting period is now only 3 years. Okay, whichever is higher you need to take into vesting period completed. I think they have already completed 2 years. Yeah, into 2 years. So 4 or 3, which is higher? 4 is 2. So that means half of this, which will be what? 2.5 lakh rupees. So 2.5 lakh rupees will be considered as a PC. This is your prorated SBPR, which will form part of your purchase consideration. Okay. Now, parent replaced it with their scheme. No? So, fair value of the old scheme is irrelevant for us. What is the fair value of the new scheme which the parent is giving? 8 lakh. So, that means the fair value of new scheme is 8 lakh. So, in this 8 lakh, 2.5 lakh rupees, you will treat it as PC. What is the balance? Balance is 5.5 lakh rupees. Balance 5 lakh 50,000, you will treat it as employment benefit expenses. Because employee still has to serve for one more year, no? So for 1 more years of service, we are giving benefit worth 5.5 lakh. That is the interpretation. So this 2.5 lakh will form part of PC. Balance 5.5 lakh will form part of is an employee benefit expense, which will be transferred off to P&L account over the vesting period. Not now. Okay. So this also 2.5 also should form part of PC. Have they taken? Yeah, they have taken. Okay. All right. Anything else? Dynamic had a lawsuit pending. The subsidiary company, they have a lawsuit pending with a customer which had made a claim of 50 lakh. Management reliably estimated that the fair value of the liability to be 5 lakh. Sir, when they say lawsuit pending and all, no? Okay, if you want, you can just check that. This 50 lakh rupees. Are you seeing any 50 lakh rupees anywhere here? No. That means what, sir? Subsidiary is considering this claim as a contingent liability. They have not yet recorded. Okay, fine. That's how it is. Are you seeing any amount there? No. That means you'll treat this as a contingent liability. But in business combination, we have already seen this is a recognition exception, right? Even though it is a contingent liability, normally contingent liabilities are not recorded, but only disclosed. But if this contingent liability of if you have done a business combination and if subsidiary company has any contingent liability, even this has to be recorded. At what value? Full value? No, at fair value. What is the fair value of this? This 50 lakh is irrelevant for me. We have to record 5 lakh. So this is a liability, right? Liability should form part of your net asset while working note. It should not come as PC. So whenever you're doing calculating fair value of net assets of subsidiary company on the date of control, this 5 lakh has to be adopted, not here. Okay. So PC is that's all. So a summation of all this will give you your PC while working. Okay. Okay. This is one. So this tax rate given check once always. Yeah, the tax rate of both the applicable entity is given to be 30%. Awesome. So that means here we need, because there is a fair value adjustment and one extra liability and all has come, you will get some deferred tax asset or deferred tax liability over here. So first let's do a fair value adjustment. Okay, so if you just check every asset at fair value, oh, no, only PPE has a fair value, right? You want fair value of net assets of subsidiary company, all the assets and liabilities you copy from balance sheet only because their fair value and book value are same. Only PPE ka, what is the book value of PPE of Dynamic? 500. Don't take 500, take the fair value which is 350. Only this asset has a fair value, rest of the assets not there. So just take this PPE ka fair value 350 you take. Rest of the other assets copy straight away from balance sheet. But also do not forget one more thing of contingent liability 5 lakh which is also in the adjustment. This is one. Okay, this one and this one is extra fitting which is given in the adjustment. These are all from here to here. Everything you will just copy from balance sheet itself because book value and fair value for all of these are same. So if you consider all of this, you will get the total fair value. But hang on, before this. Because there is a fair value adjustment, you will also get some DTA, DTL. So before you put up this working note, you should put up DTA or DTL ka working note. And DTA ka I have already told you one equation. I'll prove it to you also when I do that particular topic. For now, just learn it as an equation. DTA, how do you calculate this? For asset, one equation. Actually, there are 4. One, if you remember, automatically you can construct the other one as well. First one you try to remember. For assets, the equation is if carrying amount, if it is greater than tax base, you always create deferred tax liability. For assets, if carrying amount of the asset, if it is greater than tax base, you will create deferred tax liability. Carrying amount means as per accounts. Tax base means as per tax record. So if this is greater, you will create deferred tax liability. Okay. For if it's other way around, you will create deferred tax asset like that. Asset ka ulta is liabilities, right? So one equation, if you know, automatically all the other three you can fill it out. Now check PPE ka. Now sir, subsidiary is showing this PPE at what value in their books? 500. But can parents show 500 in their books? No, they have to show it at fair value. What is the fair value? 350. So the parent will show this PP in their books in consolidated financial statement at 350. So 350 becomes the carrying amount now in consolidated financial statement. Why? Because that is a fair value. But this fair value adjustment and all is there as per IND AS 103. Tax records does not have this. That means as per tax what? Tax base is still the original amount. What is the original amount of PP as per Dynamic? 500. So the tax base of this is still 500 only. That will not change. Yeah. Carrying amount is 350. Tax base is 500. So there's an asset equation. So carrying amount is greater than tax base or lesser than tax base. Carrying amount is lesser than tax base. By how much? The difference is 150. We don't create DTA, DTL for the difference amount, but for the taxable difference. So take this 150 and multiply 30%. You'll get 45. I think there's one more component. We'll club this. There are multiple components. Don't do calculations separately. Club all and do it. It'll be easier. Okay. So another one is contingent liability. We recorded one extra liability. It was not there in subsidiary books because contingent liability should not be recorded. This is recorded as per IND AS 103 requirement. So carrying amount of contingent liability is 5. Tax base is 0. Okay. For asset, what is the equation? If carrying amount is greater than tax base, deferred tax liability. For liability, what do you think will be the equation? For liabilities, ulta it will be. If carrying amount is greater, carrying amount of liability, if it is greater than tax base of liability, you will create deferred tax asset. So for this also, you will create a deferred tax asset. So what is the difference? 5. So both the components are resulting into deferred tax asset. So what is the total difference? 155. What is the tax rate? 30%. So take the difference, multiply by the tax rate. You will get 46.5. So you will create deferred tax asset for 46.5. So when your deferred tax asset is also an asset, just it's a timing asset, it will get reversed out in future. But for the time being, it is also an asset. So it should also form part of your net asset calculation. So how much did you get as fair value of net asset? When you add all this, you're going to get 470. Only this should be considered. No, one more asset extra should be considered, which is deferred tax asset. So if it's a deferred tax asset, one asset is coming means net assets will increase. So add deferred tax asset, just now we calculated 46.5. So the total net assets, total fair value of net assets will become 516.5. Okay. Using this, we need to calculate goodwill or bargain purchase gain. So how do you calculate goodwill, sir? One is PC. Okay. In fact, I think 1 second. I think we have NCA also here, no? I think we didn't read 70% is parent acquisition. What about NCA? What have they told? Nothing they mentioned, huh? Or we didn't read. Okay, nothing they mentioned. NCA, because no, we want to know whether NCA is measured under fair value method or net asset method. We don't have any idea. If they don't mention anything, NCA, we always assume that it is valid under PSNA basis. Because if they say fair value, some data they should give. If they don't give any data, we'll assume PSNA basis. Let's calculate goodwill here. How do you calculate goodwill or bargain purchase gain, sir? Simple. First, you will take PC. PC, we already got it. How much is PC? 87.43. That is your PC. Okay. To this, you add net assets. Or in fact, you add NCA. How much is the net assets we got? Net asset is 516.5. Net 516.5. So parent, I think, owns 70%. No? Somewhere we saw, where is that? Yeah, professional owns 70%. If professional owns, the parent owns 70% means NCI will own 30%. So you will value it under PSNA basis. 516.5 into 30% will give you how much, sir? 154.95. Okay. Deduct fair value of net assets that we just now got, 516.5. So if you do this, what are you going to get? I think balancing figure will be how much? No, I think it is not a goodwill. It's a case of you're getting a negative number. That means it's not a case of goodwill. It's a case of bargain purchase gain. I'm getting 274.12. That is your bargain purchase gain. Okay, the capital reserve basically. No, that's what you're getting. Then they're asking you to prepare balance sheet. Balance sheet is very straightforward, sir. Simple. Okay, all professional ka data, you will keep it at book value itself. Professional ka assets, normal acquisition this is. Okay, so all the professional ka assets, liabilities, equity, other equity, you will take it from the state balance sheet. Dynamic ka data, Dynamic is a subsidiary. Subsidiary ka assets and liability, only assets and liability should be taken over, not equity and other equity. Okay, but these assets and liability should be taken over at fair value. The only extra fair value here is what, sir? One is the PP. The rest of the others don't have any fair value. Only PP had a fair value, which you should not forget to consider. So you should take only 350. So dynamic ka fair value of PP was 350. Professional ka was already 300. So 300 plus 350 will give you 650. This is your consolidated balance sheet that they are showing over here. This last one. Okay, that is one. Don't forget to show goodwill. I think here it's not a case of goodwill. It's a case of bargain purchase gain. Rest of the assets line by line you add. Okay. So now what? Then equity share capital. What is the existing equity share capital? I think 1 second, maybe I'll just take this little closer so that we can just quickly compare and finish it off. Here, what is the existing equity share capital of professional? 500 as it is. Then dynamic, no, first you take 500. This is as it is. Then professional issued some shares. No, how many shares it issued? I think we already calculated that. No, 1 point or something. Where was that we calculated? PC we calculated somewhere here. Where it went. Not able to see only. Yeah. Have to calculate again now. Where it went. Here. So totally how many shares we issued? 1,40,000 shares. Okay. It was valued at 40, but the face value is only 10. No. So 1,40,000 into 10 will be how much, sir? 14. So you add 14 there. That's all. So 500 you add 14. That's why they've got 514. This is the other equity. When you're doing other equity, do not forget few things. Sir, 10 rupees is the face value of the share. You issued at 40. That means there will be securities premium. This other equity is parent. What and all extra will come? One is security premium will come. Another one is capital reserve is there, and prorated SBPR. SBPR is also a reserve, share-based payment reserve. So 3 extra thing you need to do. Capital reserve, This is your securities premium, 1,40,000 shares issued, and each share ka premium element is 30, so that's your security premium. And SBPR we already calculated 2.5. So totally 318 other equity you need to add. That is one. Okay, and then you issued some deferred consideration. No? Deferred consideration means have you already given or you're yet to give? Yet to give. That means you just made a provision. How much? I think you consider that in PC somewhere. Where is the PC? I think here only. I'll take it up from here. Here 28.93. That's what you considered in PC. No, this is your deferred consideration because right now you have made a provision. You'll settle this later, so do not forget to take this. Another one is deferred tax assets. You got deferred tax asset, but in this problem, deferred tax liability is there. So if you have both DTL and DTA, both you will not show. Whichever is higher, you knock them off. Here in this case, the DTL is 75. 40 plus 30. 40 is parent already has. Subsidiary also has 35. Now extra DTA is coming for 46.5. So totally how much is the DTL? 75 is DTL. 46.5 is DTA. So if you net them off, the difference is 28.5. Since deferred tax liability is only higher, to show it as deferred tax liability. Net off whichever is higher. If you're getting a higher number as a DTA, show it on the asset side as DTA. If netted off number is a liability, show it on the liability side as deferred tax liability. That's one thing. And one more thing is your contingent liability 5 you record. You call it as contingent liability, but book it as provisions under under current liability. Show it as provision for law damages or something. That's fine. Only that you should not forget. So these are 3-4 things you should not forget. Rest everything just take it from the balance sheet and go on adding the components one by one. Okay. So that's all this problem the way I see it. Okay. Yes, people. So with this this particular topic we have fully completed. Thank you.